So as a disclaimer always, I'm going to be talking a lot about some different Canadian stocks and where they are at today and so on. Everything should be construed for educational purposes and should not be construed as advice today, unless you guys join me later on. But right now, during this session, it's... what we want to talk today about is advanced strategies, and one of the for those people that have at least learned the most basic options education, recognize how options are priced. Options price is determined by 6 input variables, originally designed in the Black-Scholes option pricing model. And those 6 variables are like the stock price, where it's trading, the strike price from which you can exercise the option, the amount of time that that option has until it expires, the volatility of the underlying, whether that stock will be paying a dividend during the life of that option, and any interest that has to be put in. Now, all of the or discounted into the option price. So those 6 variables mashed together create a theoretical price for what that option is actually worth. The fourth variable I talked about was implied volatility. Now, implied volatility is the one variable within an options price that actually determines how much you're actually paying for in terms of additional cost for the volatility of that underlying investment. And that is not a constant. It is continuously being changed in there. If you try to buy an option during a normal market environment, you'll see, let's say that option might cost $1. Suddenly there's a chaos or turmoil within the market. There's a huge spike in implied volatility, and suddenly that option that was trading at $1 is now trading at $2, even though the stock is really not that far off from where it was actually trading. And therefore, the implied volatility is something that is very important for more advanced traders to learn, because you want to almost think of it, the best analogy that I would give is that, let's say you owned a property out on the coast of Florida, and you wanted to buy some hurricane insurance. Well, if you just randomly call and buy it, they have no problem selling it to you. But if you tried calling them to buy the insurance policy when they just announced that a hurricane was coming toward the Florida coast, what is the insurance company going to say to you? They're going to say, well, you're either going to pay a very large amount for this insurance premium, or we're not going to sell it to you at all. And the options are the same way. When everything is calm, the implied volatility within the markets is contracted, and therefore you can actually, in an orderly fashion, be buying and selling options. But then when you're trying to buy, let's say, a protective put on your stock position during a market crash, well, now you're going to have to pay a very large amount of premium for that same option, just because you're buying it during the actual crash rather than before the crash. Right, and that's an important thing. Now, in the Canadian market, we track that through what's the S&P/TSX 60 VIX index, or the volatility index. And this is a measure of volatility for Canadian stocks. Now, each individual stock has its own implied volatility, but when we want to look at what the implied volatility for the whole market is, we're looking at the VIX index. This is posted on the Montreal Exchange website, and you can regularly go and see it. But it does a very good job to reflect the type of premium you're going to be paying on any one of your individual stocks. Because if there's a big spike in the VIX-C, on the upside, because there's let's say, market risk. There's a risk that the whole market is consolidating, not just that individual stock. Well, I can guarantee you that every individual stock is going to have a bigger implied volatility during that time. So this is a very simple way for you guys to get a nice gauge as to what state the market is in terms of determining what that volatility premium is. Now, a lot of people come to me and they ask me, well, I only do debit spreads, I only do condors, I only do this type of a strategy. And they say, you know, and I ask, well, why do you just do that one strategy? Because that's the one I want to do. But really, as you become more of an advanced options trader, you'll realize that each option strategy actually is designed to work well in a certain market environment. In periods where there's very low volatility within the market, you can actually do a whole array of simple strategies because the options themselves are selling relatively cheap on a historical basis to what they would normally trade at. In the same regard, if you try to, let's say, do an option strategy during a very high volatile period, that's where you want to learn how to do spreads, and you want to learn how to do other types of strategies that create a volatility neutral. We'll talk about each one of them in a bit of detail. But in a situation where there's a very low implied volatility, or that there's not, think of it, everything is calm in the markets. There's no one worried about market declines. There's no one worried about nothing. The market's just orderly, in an orderly fashion advancing. Those periods are actually a good time to consider opening straddles or strangles, because at that moment when you're taking, and I'm going to teach you about straddles and strangles today, but those are periods where you're trying to profit from the market going either up or down, and because the option is relatively cheap, you can actually open the strategy quite easily in that market environment. What also is the benefit of that is the fact that if the volatility expands, you're actually benefiting twofold. Not only do you it doesn't matter which way the market goes because you're straddled, but also the option premium inside each of those options is actually increasing. And so you're actually making money from volatility expansion. Now, when you're doing things like covered calls, or you're doing collars and things like that, you have to, at that moment, go closer to at the money options, because at that moment, as soon as you go out of the money in any distance, you'll see that the premium just disappears. You'll see that, you know, if you do, let's say you take a Suncor and you're trying to do a covered call on it, let's say $40. Well, if you'll see in a low volatile period, the 40 pays a great premium. Suddenly you go to the 42 or 44, and you got a quarter there, or you got a nickel, or you know, it's just not there. And so what you'll see is in the low volatility periods, you end up doing a lot of strategies associated with at the money, because that's the only place where there really is any premium. Now, in the same regard, in periods of high implied volatility, where you see these big spikes, and during those environments, options become very expensive. And a lot of people get lured into wanting to be in an option in that market environment, but ultimately they don't recognize how big of a premium they're paying. There's situations where they might be right about I'll give you an example. If you, during the flash crash, and back, the 1-year anniversary just passed right now, back in 2010 during that May flash crash drop. If you, let's say, some of these stocks maybe dropped $3, $4, $5 in a matter of literally minutes. It was like it was a 20-minute crash, and literally a drop. But if you turned around and tried to buy a call option on one of these stocks that dropped to try a profit going up, well, the implied volatility literally tripled during that market decline, and so you literally paid so much premium for that call option that when the stock rebounded, the stock may have moved $2, $3, $4 back the other way, and you're up 50 cents on your call option. You're wondering, why didn't I make any reasonable amount of money? It's because you bought an option in a very high implied volatility, and you lost money from the contraction of it. We in the options world try to analyze that through what are called the option Greeks. And the option Greeks, when you're looking at how your option price changes as Vega is going up or down, it determines how a percentage change in that implied volatility is actually affecting your option. But nonetheless, the point I really want to get across here is that I want to help you determine which option strategies work best in what environments. And why you would want to use one during that period. Like in periods of very low volatile periods, there's nothing wrong with just keeping your strategy simple. Buy a call or buy a put. There's no problem. Why make it any more complex than that? But if you're in a period where volatility is very high, you need to offset that volatility somehow. You need to find a way to make that volatility not a part of the equation, or at least mitigate some of the effects that volatility spike had in your strategy. So the first strategy that I want to cover with you is the idea of a call debit spread. This here is what I call a volatility neutral strategy. It's a strategy where we can open even during periods of very high volatility. The concept behind it is that we would turn around and buy one call, and it doesn't matter whether that one call is very expensive, because if you are buying an expensive call, when we sell another call, it will also be a very expensive call, and you therefore are receiving a very big premium. Now, if you therefore bought one call and then sold another, what you've done is created a strategy that if the volatility contracted on those options, what you lose on the one, you gained on the other. And therefore it made it, it mitigated a lot of the risk associated with volatility during that period. So if you, let's say, are trying to call the bottom of a market crash, let's say the market's dropping. If you're doing that, like I'll give you an example. Right now, if you wanted to try to call the bottom on silver, well, you know, the implied volatility on silver is spiking to its historical levels. Right now, if you turn around and said, I'm going to try to time the bottom of silver, and you try to buy a call option on it, well, you're going to find that you're paying an astronomical amount of money for one of these call options. This is, if you were of that conviction that that's what you want to do, then a call debit spread becomes your most viable way of profiting from that kind of a forecast. So it's also, the call debit spread is also called the bull call spread. And what it involves is that we would turn around and buy one call option and then sell one call option at a higher strike. Now, that call option that you sell is not deemed to be naked, because if in order for that call to get exercised, the one you sold, the one that you bought would already be in the money. And therefore, the one would offset the other. And therefore, the risk associated with the selling of the call, you don't actually have to own the stock like a covered call or be naked. The one call is offsetting the other. What you'll see, if you held one of these bull call spreads right until its expiration, if both of them were in the money in a sense that you were profitable on it, the clearing corporation would exercise both of them simultaneously. And what would happen is you would buy, let's say, 100 shares and simultaneously sell 100 shares, and you would have got to keep the difference. And you would never really see the shares even appear in your account so long as both of them were in the money. And so, let's look at a couple of examples of how a bull call spread works. The first thing is that your outlook has to be moderately bullish. And the times when it's ideal to use a spread like this is opening the positions into very volatile markets. And it doesn't have to be, the stock market has to be volatile, but that individual stock must be going through some sort of volatile period. If you're seeing very big moves in a stock in a very short time frame, I can guarantee you it's pricing in a very big implied volatility. Market makers are not in the business of giving you guys free money. Ultimately, every option is attempted to be priced accurately for its theoretical value. Now, what happens here is the short position offsets the cost of the trade and reduces your break-even point on the position. It also reduces the potential loss, because if you didn't only paid a smaller amount for the outlay, if you just bought the call option, you risk losing a lot more, right? So your outlay of money is less, but the loss to it is the fact that if you were really right and that stock rallied very far, you were not going to participate beyond the short call strike price. So in other words, you only want to be moderately bullish. If you are very bullish and you believe, let's say, a stock has the potential to go $10, $15 higher, then a bull call debit spread may not be appropriate. But if you, let's say, believe that, let's say, TD Bank is going to go from $82 back to $86, well, that's moderately bullish. That's not, you're not looking for TD Bank to go to 100. So long as you're bullish but not outright bullish, the bull call spread is a very good strategy to deploy in those environments. The other thing about them, and like I said earlier, is that it is what's called volatility neutral. Now, if you had a situation where you owned a call, if you just bought a call, and during that time, the implied volatility, let's say on that stock, went from 30 down to 25, even if the stock price never changed, you would have actually lost money on that option. Because that option, now pricing in only an implied volatility of 25, is going to be selling cheaper. But if you did a bull call spread at that 25, when the implied volatility was 30, then when that implied volatility goes from 30 down to 25, you lose a certain amount of money on the call option that you're long, but you make money on the short option, as that therefore also contracts. And therefore it makes the strategy volatility neutral. This is why actually the debit spread is a fabulous way of learning to actually trade options. Because for beginners that don't understand what the implications of implied volatility have to their strategy, the bull call spread allows them to make, most people when they buy a call option, it's only because they believe the stock is going up. They don't take all the other things into consideration of how much time they're putting on the option and what its the state of its implied volatility. They just want to be right on their forecast. I think Suncor is going higher, so I'm going to buy a call because I want it to go higher. The bull call spread allows you to mitigate much of the other variables associated with options, especially the ones you're exposed to when you just buy a call. A lot of times I've seen investors where they'll buy a call, they'll be right about the move, but they chose the wrong strike price and didn't give themselves enough time. And even though the stock went up like they thought, the option still expired, and they didn't make any money on it. Right? You need to learn to create a strategy that allows you to profit from what you actually believe will happen. Now, the first key thing to a bull call spread is to choose an expiration date that allows the stock enough time to make the anticipated move. What you'll see is that as you go farther and farther out, the bull call spreads don't actually become that much more expensive. Let's say if you, we're going to do some examples. So for those of you that are new to this, we'll look at some different examples in a bit. But I want to get the point across that if you went out right now and did a May bull call spread, let's say on Suncor from 45 to 50, or 44 to 50, let's say. There's no 45 strike. But if we did a 44 to 50 strike out to May, if you turned around and did that same spread out till June, and then did the same one to July, you'll see that the spread doesn't become that much more expensive. In fact, you'll see that the spread is actually costs almost very similar. So really, you just really have to pick the amount of time that you believe you will need in order for your forecast to come to fruition. The key element of a bull call spread is that at the time to reach your maximum profit potential, you need the option to both options to expire when the stock is at or above your target. Right? And so if you buy too much time, if you, let's say, go out and buy a 3-month debit spread and the stock gets to your target in 4 weeks, well, now you have this problem where, well, now I need the stock to stay up here for another 2 months in order for me to maximize the full benefit I can make on the spread. At that moment, you can close the spread profitably, but you're not going to have realized the total benefit of this that's available to you in the spread. Now, at the money and in the money, strikes are more conservative but are priced higher because options are priced based on probabilities. And therefore, we have to understand is if you go with the call option at or in the money, there's a much greater chance that that option will actually have real value come the expiration. And therefore, the spread will cost more. While if you go out of the money on the spreads, it'll cost less for the spread, but now it's less probable that you'll be right. It's all related that way. Ultimately, sometimes doing out of the money, less expensive spreads is not a bad way so long as you're really bullish on the stock. Because if you can, let's say, open up a $6 spread for $1, well, you now have $5 profit potential. You know, that could be a very handsome return if you're right on that forecast, but you obviously need the stock to move that much more in order for there to be, for you to actually start gaining intrinsic value on those moves. So let's look at an example. We'll use an example of Goldcorp. Now this is Goldcorp back in late November when we originally built these slides. Since then, Goldcorp, I don't know how many of you own Goldcorp, but Goldcorp basically went all the way down to about $39. Well, then went all the way up to 53, and then today it's still trading roughly around 46. So it took investors on quite the roller coaster ride over the last 4 or 5 months. But certainly in this situation back in December, if one had the conviction that Goldcorp could actually move higher and have a bullish outlook, let's just say at this moment we want to consider how are we going to open up a bull call spread on Goldcorp to try a profit from this move. So in this situation, so Goldcorp is at $46.05. And the January expiration, which has 57 days till its expiry at the time when we did this example, we buy one of the January 46 calls. Now it costs $2.13. Now, if we just bought that call, so let's pretend we didn't actually sell the other call, we would need Goldcorp to rally above $48.13 by its expiration just to retain the intrinsic value of what we paid for the option. Now, by selling that $50 call option and making a 67-cent income, we actually were able to create a net cost of only $1.46, right? But now what we've done is we've actually boxed our profit potential. We don't have any of the upside potential above $50 because we're now short an option there. So really our profit potential lies in the spread between $46 and $50. Right? And so long as we're moderately bullish on Goldcorp at this time, it allows us to actually participate in it that way. So what we've created, just using a traditional options risk graph, we've created a break-even at $47.46. So come option expiration in January, if that stock was trading exactly at $47.46, we would have just broken even on the trade. Now, as soon as that stock hits $50 on the upside is where we have our maximum profit potential of that $254. But what we've really done is created almost, and you'll see that when we cover callers later on in today's session, you'll see that the risk graph is very similar characteristics. We have a defined upside and a defined loss. And in this situation, the most we could possibly lose in this bull call spread is the $146 for every 100 shares that we would be opening. So, you know, when Goldcorp went here from $46 down to $39, how much would an investor that owned the stock spend down? You know, like it would have been down $700. Here, our maximum loss was $146. So what we've done is we have a defined, quantified loss that we can actually manage within the trade. And we have that profit potential up towards $50. So, and just to demonstrate it on just a table, you can see as that stock is rallying higher and higher, you can't really make any more on the spread. Now, at the end of my presentation this morning, I'm going to be introducing you to the idea of rolling a spread, which is where we could take that $50 strike and roll it up to a 52 or a 54. In doing so, we can continue to give the stock further upside, but I'm not going to cover that at the beginning stage here. That's going to be at the end of today's morning presentation, then I'll cover that after the break. But nonetheless, if we did nothing and we just held the spread right up till that January period, then the maximum profit we can make, no matter how high it goes above 50, is just that spread of $254. So I also like to illustrate on a chart, and you can see here the red zone is where you're still incurring a loss, and you essentially need the stock to get into the green box in order for you to be profitable. Now notice that above the green box you can't make more. So remember we said we have to be moderately bullish to use a debit spread. Because if you're outright bullish, if you believed that Goldcorp was heading to $60, well, why would you cut it off at 50? Right? At that moment, you're doing the wrong strategy. If your outlook was extraordinarily bullish on the stock at the time, then that's certainly something that would have to be considered. Now, alternatively, what is really nice is that we could do these put debit spreads. And the debit spread on a put is the exact same thing, but we do it with puts. And it's a very good alternative to short selling. A lot of times people will have a conviction that they believe a stock is going down, even if it's a stock that you own, and you want it to hedge out some of the immediate risk of your own stock dropping. You can just open a spread in order to try to remove some of the immediate risk, right? Like at this stage, you know, we're going into the sell in May and go away time frame, right? And so this is a period where, at least through history, the stock market has found it challenging to make any progress. It doesn't mean that it has to crash, but it certainly isn't, at least historically, finds it very difficult to make money in this environment. So if you, let's say, held a bank stock for the last 6 months, and let's say you rode one of these bank stocks like TD Bank or something, and just for the sake of no other bank that I could think of, but the TD, let's say, rallied up to 86. Now it's at $82. And let's say you were of the conviction that there's a chance that TD may even go down to $80 or $78. Well, you're not really bearish on TD. You just think that, you know, stocks go up and then the stocks go down. And you own these shares. You just want to find a way to even hedge out some of the risk that if the stock pulled back, that you can at least retain some of the profits that you've made while owning the stock. We'll talk about that with callers a little bit later, but in this situation, the bear put spread or the put debit spread, we buy a put and then sell one put at a lower strike price. What we're trying to do is profit from it actually dropping. Again, this is a very good strategy to do. If, like, I'll give you an example. When Research in Motion came out with its earnings warning and surprised everyone and did that big drop of like $7 in one day. If you at that moment were of the conviction that there should be further weakness in Research in Motion, if you just tried to buy a put option that day after the announcement, the implied volatility on Research in Motion was literally double that of what it was the day before. Right? It literally you were paying a massive premium to go out there and buy a put option. So here, even if you were right, and then Research in Motion did further weaken afterwards, but if you overpaid for the put, you really didn't make any real money off of it, even though you were sort of right that the stock continued to weaken. But if you were of that conviction, the best strategy would have been one of these put debit spreads. Because if you're going to buy a very expensive put on Research in Motion to try to anticipate it going lower, why not offset it by selling another expensive put option at a lower strike price to reduce the cost of actually doing the spread? Now, if Research in Motion continued to decline on its way down this way, then you had the opportunity to profit from that move, but reduce your costs and your break-evens for actually having done it. So your outlook here has to be moderately bearish. So in this situation, if let's say Research in Motion was already off of over the course of a month or two, is let's say already, you know, $15 off its highest point, and it's gapping down another $7. Yes, the stock can further weaken, but much of the worst case scenarios have already been priced into the stock, have they not? Like ultimately at that moment it's already selling cheap. So you're sort of only at that moment really moderately bearish. You're not looking for Research in Motion to drop to 20 bucks. You're just expecting it to further weaken. Makes it a very good candidate. If you, in the same regard, if you are near a market top, let's say you're trying to call the top of silver back 2 weeks ago, well, you wouldn't want to cut off your downside potential trying to catch the top on silver, because that moment, if you had a really big drop, you're not profiting from it. So that you have to be selective as to when you're using it. But again, the best time is when there's big volatility in the underlying to actually open these positions. So in this situation, let's just say at the same time, this was actually the move that did occur, but if let's say you were of the bearish conviction at the same time back in November on Goldcorp, and well here, 46.05, let's say the investor believes that the stock has the potential to come down toward that $42 area where all those lows have come in the earlier time frame. So this investor is looking at opening a combination of options to allow them to participate or profit from this stock dropping down to this $42 level. So in this example here, Goldcorp is at 46.05, and you can see a January $46 put at the time was asking $2.06. So I'm not even assuming that you're trying to split the spreads. This is the actual ask prices that the market makers were willing to do business with you at the time. And you turn around and sell a January $42 put, and at that strike price, you collect 58-cent income. So now you outlaid $1.48 out of your pocket, and you've reduced the cost of the spread by that 58 cents, or the cost of that put by 58 cents, while you're going and trying to participate on that move going down. So it literally creates the same type of a risk graph that we saw with the bull call spread, but this time notice the green side is as the stock is going down. So along the x-axis, as the stock is actually declining in price, you become profitable from the stock dropping rather than the stock going up. And so really, we're doing the bull call spread and the bear put spread are really the same strategies. It's just if you do it with puts, you want the stock to go down. When you do it with calls, you want the stock to go up, right? And it all depends on you as an investor what your conviction is for that particular stock to move. In this situation, the most you could become profitable is $252. Why is that? Because what is the spread between the two strike prices? $4, right? So if you pay $148 for that option and you have a $400 potential, then only the remaining $252 is your actual profit potential. Does everyone understand that? I'll tell you, this is these strategies of the spreads like this is a great way to learn how to trade options. Because you don't have the variables associated with just buying a call or buying a put outright, where you have to fight all the volatility variables, time decay variables, and other things like that that are continuously eroding at you, while with these spreads you've actually offset much of that by doing a combination. So again, you can see as the stock here is dropping, as it goes lower and lower, you can see that you cannot make more than that $252 on that position. And in the same regard, your maximum loss, and you cannot possibly lose more, is that $148. And this allows you to take a more decisive positions where you can understand what your worst case scenario is. In many cases, when we open them up, we just consider the spread, what we paid for it, to be the entire risk capital. We don't even bother using stop losses on them. You know, you outlay basically $148 and you say, that is what I'm paying to participate in this move. And if I'm wrong, I'm going to lose $148. We can't always be right, but you want to know what your worst case scenario is every time when you're within there. So in this situation, you can see on this chart, we would have, if I just go back here, your break even on the stock is 44.52. So you can see here that the stock would have, from here, have to have dropped to that 44.52 in order for you to get in the money enough for that spread to actually start making money. And the most ideal moment is that you're below the green zone on its expiration. So as soon as if that stock price is trading anywhere below that green box, come that January expiration, you got to keep that full profit on that trade. The one thing you'll recognize is that if you try to close a spread early, you'll never receive the full premium because you're going to have to give a certain amount of time value back. The only time you'll really benefit from the full spread is when time decay has completely eroded within the spread. But in many cases, like when you turn around and let's say if you pay $1.50 for, or let's say you pay $2 for a $6 spread, if you are at your price target 2-3 weeks later, you know, closing out something you paid $2 for, a $4 value instead of a $6 value, well, you still made 100% return on the spread. It's not like you have to sit there and hold on to it. If you're happy with the fact that the move happened and you actually were able to capture it, you actually turn around and lock it in and sell it anyway. So that spreads. Before we go on to straddles and strangles, does anyone have any questions on these spreads? Yes. The question in the audience was when you're doing credit spreads, do the same type of rules apply? Ultimately, the credit spreads are a different type of an animal because ultimately you don't want the stock to go to where your spread is. The debit spread, you actually want it to go there. And the credit spread, you want it to go away from there. So it's almost inverse. So you wouldn't want to use the slides here to kind of make the same implications. Credit spreads, think of credit spreads a lot like cash covered put writing or even naked option writing. You want, in order for that option to expire and you get to keep that money, you don't want the stock to go there. You want the option to just expire and you get to keep it. So you have to change the way you look at it a little differently. Really in the end, credit spreads, all they represent is a way of not doing naked writing. Ultimately, if you're not approved to do naked calls and naked puts in your account, well, doing call credit spreads and put credit spreads, what you're doing is you're selling a naked option, but defining your absolute worst case scenario by buying another option to maximize what your worst case scenario loss is. And so it's really just all the rules. If you've ever seen any of our presentations on option writing, whether naked call writing or naked put writing, those are the ones that best relate to credit spreads. So any other questions? Yes? The question here was just trying to determine whether or not you should not sell before expiry. There's you can close it early at any point. If it goes in your favor and you're up money, you can close it at any time. But if you wanted to catch the absolute complete profit in the spread. So in this example that we were showing a $252 maximum spread. You cannot realize $252 profit if you closed it early. The only point where you will actually see the $252 profit there is on expiration. So just think that if you close the debit spread early, a lot of times it's a simple question. Look, the stock did what I expected it to do. Now you have the thing of, I'm trying to make a little bit more money, but now you have to bet on whether the stock will stay there. Because there's nothing worse than saying I'm going to hold it right till its expiration, and you were right 2 weeks later, and then 2 weeks after that, it comes all the way back to where you started, and you had a chance to take this beautiful profit, and your forecast was right, but you didn't close it, right? But ultimately, that's why choosing which months to go to is very important. In many cases, because the oppositions are offsetting the volatility risk and the time decay, you can, in many cases, open these spreads shorter time frames. And so that way it's about making a short-term technical observation that you believe that this is going to happen over a short time frame. I wouldn't recommend that if you, let's say, had an outlook that you think the stock's going to go higher and you turn around and open a 6-month debit spread. I would discourage you from that. You know, if you believe the stock's going there right now, then you should be doing a 1 month or a 2 month spread on it. You don't really want to go and buy too much time. So what I want to cover next is the idea of longs, triangles, and straddles. First I'm just going to cover an equal ratioed one, but afterwards we're going to cover the ratioed straddles and strangles, which I think is a little bit of a better way of doing it, but we'll talk about that. In fact, Richard is going to cover strangles and straddles himself in his presentation a little bit later today. And he'll be covering that in there. And straddles and strangles are very interesting strategies, is because ultimately it's implying that you don't care which way the stock market's going to go. As long as it goes there fast and goes there with a little bit of speed. The worst thing you could do is open straddles and strangles into low volatile periods where the market is not doing anything. So right now, let's say if the stock market for the summer doesn't end up crashing and it ends up being more of a sideways consolidation, if it does that, then straddles and strangles going into the summer may not be the most appropriate time to open them. While if you think about it, back in September of last year, opening up straddles would have worked phenomenally. Because at that moment, the market was either going to have a very strong decline and go back into a recession, or two, the market was going to have a very robust rally. And in the end, it was a rally, and you were able to profit from a very big move. But the time when a straddle and a strangle's open is when you believe that some sort of a big move will occur. You're just not 100% certain whether that's going to be up or down. Now, a long straddle requires the purchase of a call option or a put option and a put option simultaneously. Both straddles and strangles are volatility trades, and therefore you're anticipating a very sharp move in either direction. And I want to emphasize the word sharp, because you are buying two options. One, so you're almost paying double the premium. And what you're really counting on is that that stock or that security is going to move, let's say, even to the second or third standard deviation. It's just going to go to a very big move. If the stock just goes $2, $3 in one direction, you're going to find that the straddles and strangles aren't making you very much money at all. You really need the market to actually have a significant move. The whole thing with the opening up one of these is that the break even is much higher. You have a lot more that you have to do in that spread. We'll look at an example of Goldcorp, and I'll talk you guys through it here. But let's go and look at a long straddle. And in this example, a long straddle, let's say we have the same underlying security. And what we're doing is we're buying a call and we're buying a put at the same strike at the same expiration. So you can design these straddles to be calendar straddles, ratioed straddles. There's all sorts of different things we can do. But to be just a clean and traditional straddle, they're going to have the same strike and the same expiration. So in this example, a straddle, we're looking at this stock, let's say at $40 a share, YZ. And the investor expects the stock will be considerably volatile. Investor wants to capitalize on a big move irrespective of the direction. And so they're looking at a 6-month $40 call option, which was $3, and a 6-month $40 put option, which is also costing $3. So now it's a very simple thing. Each one of those 6-month options is you know, 7-8% premium that you're paying for the cost of buying that. But you're buying two of them, right? So how much did you outlay? $6, right? So ultimately what happens is that we buy the $40 call, we buy a $40 put, and so the net cost is $60. So it's called the $40 straddle, and it outlaid $600. But one of those, either the call or the put, is going to make money, But one thing I'll tell you with some degree of certainty is that the vast majority of stocks always make moves. Very few times you see, unless you're holding like TransAlta, which is like stayed the same for like for forever. But beyond a stock like that, stocks do tend to make some very big moves in either direction. And so what you're doing with a straddle is you're conceding that I have no clue which way it's going to go. But it's going to go one way or another, and it's going to go big, right? And so what happens is you're trying to profit from making a very specific trade that allows you to profit whichever way it goes. So your break-evens on the stock basically at $34 below and $46 above. So if you can't profit from short-term timing the straddle, then you will need the stock to rally above 46 or below 34 for there to be any real value in the end. And this is why we said it has to move quite extensively, because just because this $40 stock goes from 40 to 42, you can't have a smile on your face saying, oh great, it was a success. Well no, because you haven't really got any benefit in that move. You need that stock to go from 40 to 55 to $60. You need a big 6-month rally, something that can happen. Usually at least if you use history as a good benchmark, the time for straddles is, in many cases, is usually in late summer and fall, because there tends to be usually, 3 out of 4 years, there tends to be a market that rallies going into Christmas and into January. It's just a very naturally bullish period within the stock market. And so if you're trying to anticipate a very big move, then you can certainly open up a straddle and try to profit from it. Now, recognize, would it be a good time to consider opening a straddle when volatility is very high? No. Because if let's say there was a big spike of implied volatility, let's say this was research in motion and it just dropped to $40 on a big rapid decline off of that announcement. If you right now tried to open a straddle saying, I think research in motion is either going to go up or down, instead of paying $3 for the call and $3 for the put, you might be paying $4.50 for the call and $4.50 for the put. Now you have a $9 spread. And now you would need the stock to go to $49 on the upside or $31 on the downside to gain any value. You'll realize that at that moment, you need an even bigger move to do it. So straddles and strangles are a very poor strategy in very high volatile periods. And that's why you want to use something like that VIX-C index that's on the Montreal Exchange website. Because if you see that the implied volatility of the whole market is very high, then you should immediately rule out straddles and strangles. Like it's not worth overpaying for these options to do this. At that moment, open up a debit spread in the direction you think the market is going, and you could participate in those high volatile periods in the direction you actually think that these stocks will actually move. And this is why learning all these different option strategies, if you want to consider yourself a sophisticated investor, or you're striving to be a professional or sophisticated investor or trader, what you want to do is consider each option strategy to be a different weapon in your arsenal. And there's different times you're going to pull out different weapons to achieve different things, right? Ultimately, there's a certain time where a debit spread is the most appropriate. There's another time where iron condor is the most appropriate. There's another time when you want to do this strategy or that strategy, or collar it rather than just doing a straight out cover call. You want to know each strategy, and more importantly, not only do you want to know the strategy, but you want to know when that strategy is most effective. Because you need to be able to adapt your investment approach to the market environment, right? And that's something that you all want to learn. So what a straddle does is it creates this kind of a V shape. Ultimately, recognize is that even though in order to become profitable, we needed that stock to go below 34 or above 46. Recognize that the only point where you could actually lose the entire $600 is if it closed exactly at $40 6 months from now. Recognize if it's anywhere not at $40, let's say it's at 38 or at 42. Understand one of the call or the put will have an intrinsic value. And that intrinsic value means that you might only take a $400 loss or a $300 loss or a $200 loss. It's not always going to be $600. It's not like a debit spread that if you're wrong, that entire debit spread expires and your $150 is completely gone. Right? It's what we're looking at is the fact that the worst loss only can happen exactly at 40. And that's why that V-shaped cut at the bottom is exactly at the $40 strike. So you can see here that over a 6-month time frame, in order to get that really nice big kick in profits, is you want that stock to have a very significant rally. You can see as it approaches $50 and $60 is where you start making real money on the upside, or you want the stock to outright collapse, and then you're really making the money down into the $30 and $20 strikes down below. Now, so in this example, we're going to go back to Goldcorp. I want to keep it simple, so we're kind of using all the exact same scenario. Here, in this Goldcorp example, the same stock prices we've been looking at for the debit spreads. Let's just say that the investor is expecting a very volatile move, right? Now, in this situation, we can turn around. We can turn around and buy, so it says RIM there, but that's actually supposed to say Goldcorp. It's at 46.05. We buy the $46 call at $3.55. And then we also buy the $46 put for $3.45. So the net cost was $7 for basically these 140-day spread. Now, the $46 straddle costs $700, and basically your break even on Goldcorp is either $39 on the downside or $53 on the upside. And just to give you an example of what Goldcorp really did was basically going into January from November, it dropped all the way to $39. Turned around and then rallied all the way to $53. It was funny that it worked out exactly that way, but it never actually left the break-even zones in this example. It actually perfectly went all the way to the downside of the spread and went all the way back up. But let me ask you something. If you were in Goldcorp here, let me just see if I have this here. So you can see we would need a pretty significant move higher or lower in Goldcorp in order to make any money. But let me ask you something. If, let's say you opened that $46 straddle on Goldcorp, when it was, a month or two later, when Goldcorp was trading at $39, what could you have done? Sold the put, because you're making money. Then, if you sold the put and all you had was this call, when Goldcorp reversed and went from 39 all the way up to 53, what would you have done with the call option? Sell the call. And even though it really stayed within that spread, you actually could have profited from that big swing down and the big swing up because you closed one leg of the straddle. You don't have to have a rule that says I only close the straddle together. Like ultimately, you can market time the call and the put as you please, right? So ultimately, if it goes one direction and and that one option is making you a very large profit, you turn around, take that profit, hold the other position, and wait for the stock to bounce back. And when it does, you turn around and sell the other one for a break even or a profit, and you've now profited twofold on the strategy. This is a very effective. If you consider yourself to be a very poor market timer, this is a great strategy because in the end you don't have to be right about the initial direction. You just need the stock to make a very big move. And once that stock makes a very big move, you can immediately take profits on the one side and then try a profit on the other. So in this, here, using that Goldcorp example, you can see that you created a pretty wide range where if you just held both legs and you didn't market time them like I demonstrated to you, like we close one and close the other, you're only profitable when it leaves this band. And that basically is not a very high probability scenario unless you actually really have the conviction that, that these stocks are very expensive, or the stock is very cheap, and it could actually have a very, very big move in either direction. And you really have to be of that conviction in order to trade these types of strategies. Now, if you think about it, what are some of the ways you can offset the cost of a straddle? You can sell other options at higher strike prices to reduce the cost, creating almost a wrap of debit spreads on either side. There's all sorts of different things investors can do to try to offset the cost of a straddle. But ultimately, straddle is something that let's say Richard Croft uses straddles for, and I'll let him talk about it when he speaks earlier. But he uses it as a way to reduce the volatility of a portfolio, because if he opened up a straddle and suddenly within a portfolio that he owns a series of stocks and other things in, then if the, let's say, market is dropping, then what happens is that the puts that are owned within the straddle are creating profit, and therefore creating almost a hedge within for the rest of the portfolio. But in the same regard, if the stocks continue to rally, he's making money on the stocks, but then he's also offsetting the cost of the put by the call option that he owns going in the other direction. So there's all sorts of ways that you can learn to combine straddles into a portfolio to reduce volatility and create different ways that your own portfolios function. Now I want to talk about the idea of using a long strangle. A strangle, in fact, is almost the same strategy as a straddle. That's why we put them together. And, but the thing is that it's the same underlying security. We buy a call or a put. We buy a call and we buy a put, sorry. And the put is at a lower strike price than the call for the same expiration. And so when we're looking at this here, again, yes, question?
For a straddle, do you have any suggestion how many months forward is best, like 3 months, 4 months, 6 months?
The question in the room was, just to repeat it, was how long do you open a straddle for? Do you go out 2 months, 3 months, 5 months, or so on? And that really actually has to be a function of your expectation. Recognize that the more time you add to a straddle, the greater chance that that stock will make a very big move during that time. But you are paying more for the option. So you actually therefore need it to go farther in order to actually become profitable. So it's not a right or wrong answer. What you really have to look at is that what do you really believe is the window from which a very volatile move could actually occur. So if you believe that right now, let's just say you were of the conviction that the sell in May, go away thing will probably work this year, and let's say you believed that the stock market, there's a legitimate chance that there could be a correction of some sort of significance. Let's just not go into dilly-dally about how much and how far, but if we're wrong, then the stock market will use this last couple weeks of consolidation as a springboard to go and make another big push higher. So if, let's say you were of the opinion that you wanted to open a straddle in this market environment, either A, to profit from a big corrective move down, or subsequently this being a buying opportunity if you're wrong and it goes the other way, you probably will not need to open a 7 or 8 month position. Ultimately here, if there's going to be a correction in this market, it probably should occur over the next couple of months. So why would you go out and open a straddle for 6 months or 9 months? You probably only need a straddle for 2 months in time. Right? So it's not a right or wrong answer. You have to look at the scenario, what your expectation is to occur at that time, and then you open it up and
What I was hoping is to get answer from your experience. You generally go 2 months, you generally go 4 months.
Well, he's asking from my personal experience, what do I find? Well, first of all, for those of you that do know me, we strive to be market timers. And so we rarely open straddles and strangles. We usually have a conviction that the stock market's going higher or lower, and we take very specific directional calls for that. So we're not really using a lot of straddles and strangles, because that's more assuming that it could go higher, it could go lower, and we don't care which way it goes, and that's not our style, right? But I'll tell you, so I can only tell you by that kind of perspective of that. You want to make sure that you have enough time, but not too much time. You want to time it so that you can actually become profitable within that volatile move. So let's look at a strangle example here. And so here we have the XYZ stock at $40 a share. And the investor expects that the stock will be considerably volatile, wants to capitalize on the move. And so now look at this. They're looking at a 6-month call option at 44 and a 6-month put option at 36. The straddle was what? What strikes were both of them at? At 40. Right? So basically, when we did a straddle, the two strikes were at the exact same strike price. And therefore, you outlaid a very big amount of premium because they were both at the money. And that's where options are the most expensive, right? Is when you look at an at-the-money option. So here, a 6-month 44 call or a 6-month 36 call, notice that they're cheaper. They're only $1.25 each on this play. And so now what happens is that, how much should we have to outlay for the straddle? $600, right? For every one call and one put that we bought. But here, how much do we have to outlay? $250. So notice here with the straddle, we've created a smaller cash outlay. What makes this effective for strangles is the fact that if you're one of those people that likes to calculate your returns by a percentage based on what you initially outlaid, it'll be easier to make $2.50 profit and make 100% return on a straddle than it would be to have to make up $600 or $6 on on the straddle rather than strangle. So here we buy a 44 call and we buy a $36 put for $1.25 each. And so we have a net cost of $2.50. The 3644 strangle outlays $250 representing your maximum risk. So a lot of traders like this because they end up saying, look, the stock is going to move big one way or another. It's either going to go up big or it's going to go down big. And so what they do is they just need to go a few strike prices out where they don't have to worry about outlaying too much capital. And in the end, if you're only putting $250 into the strangle, it allows you to outlay a lot less risk and yet have the same directional conviction. Because look at this, the break even on the trade is what? $33.50 and $46.50. Notice that actually is not actually any different than what it was for the straddle. The straddle had a break even of $34.46. So we only outlaid $250, but our profit zone actually lies literally in the exact same zone as it did for the straddle. So with a strangle, it allows you to outlay far less cash. That's the biggest advantage. And I'll tell you, one of the, especially you'll learn one thing quick is that when you lose, you want to lose small. And when you win, you want to win big, but you got to learn to lose small. And if you're outlaying $600 or you're outlaying $250, that's your maximum risk. So why would you risk $600 instead of $250, right? Or $2.50. So notice though the difference here on the strangle versus the straddle is that V shape doesn't end in a point at the bottom. Because now there's this $8 zone between the $36 and the $44 strikes that you bought, where you're going to have the full $250 loss. right? So your maximum $250 loss, if the stock closes at 37 or the stock closes at 43, you are going to have, if you held the straddle right up until expiration, both options would have expired and you would have lost the entire $250. And you would have had to been prepared to have risked that $250 in that trade. But notice that in the same way, once it crosses that 34 area and once it crosses that $46 area, you're making money at the same pace as the person with the straddle, basically, right? Because by then those options are in the money. And so notice here, as if you only outlaid $2.50, just if that stock hit $50 on the upside, well, you made $3.50 profit. That's well over 100%, right? So what happens is that with the strangle, you can, if you're trying to analyze your returns by a percentage, it's much easier to make a high percentage return on strangles. If you open the same amount of straddles as strangles, you're roughly talking about the same amount of gross money profit, but percentage-wise, it'll be bigger. There's a question? No. Yes. The question here was, would this be appropriate for something like silver, which was going parabolic in the last couple weeks as it was making that rise? The biggest problem with a stock that's going parabolic or an ETF or something like a commodity like silver, when it's going at such a rapid pace, the implied volatility is very, very high. And so in that situation, you would have been paying a very large sum of money for the call and a very large sum of money for the put, which would have made it a very expensive proposition. But the way that silver did move, it would have still been very profitable because it was such a very rapid move that occurred in a very short time frame that you would have made money even if you overpaid for those options. But you really do, as long as you're anticipating a very volatile move. Like silver is a good and interesting scenario because when it was up in that $45, $50 an ounce level, there was nothing stopping from silver on a short time frame from going all the way up to even $60 on a big push. But ultimately, when a stock goes up that fast, when it runs out of steam, it crashes. Anyone that's been around the block in the stock market knows exactly how those things pan out. And so opening something like this kind of a strangle on silver would have been an interesting play because we didn't know whether silver was still going to make another leg higher versus reversing back down. So let's look at an example here using Goldcorp. We've been using that example throughout this time frame. And so again, the investor is anticipating a potentially volatile move. And in this situation, we're going to now open up. We're going to open up now a 44 to 48 spread a strangle. And so the stock's trading at $46. We're going to buy, let's say in April, which was again about 6 months out, a $48 call, which was costing about $2.75 at the time. And we're going to buy a $44 put, which basically also costs about $2.54. And the net cost, therefore, is $5.29. So now we have a $44 to $48 strike strangle, which represents a total cash outlay of $529, representing your maximum risk. So if by chance Goldcorp over the next 6 months ended up closing at the end of the 6 months anywhere between $44 to $48, you would have, that entire sum of money would have expired. Now, in the same time, though, Goldcorp again went all the way down to 39 and went all the way to 53. So you had ample opportunities to be closing out legs of the strangle along the way. But right now, with today, it's trading back around $46. If you held it until now, you would have found yourself exactly at the same price that when you actually opened it. So your break even now on Goldcorp is the $40.71 and $51.34 on the upside. Notice that how a little bit. Notice that on this on the straddle, your break even on the straddle was $39 on the downside, and it was $53 on the upside. And so what you see here is that by opening it up as a strangle and by paying less money, we actually allowed room for it to become more profitable quicker. What overall you'll find that I find, at least for retail investors, the strangles tend to represent more of what they're looking for, because they have a much higher chance of a very big percentage return, and they're outlaying less money for doing it, and therefore can quantify that loss a little bit better. But there are times when straddles will work better than strangles. But in this situation, you can see that the straddle has a lot of benefit to it. Or the strangle. So you can see here that, again, the same graph, the same way, we would need that stock to rally above $51 in order for the entire straddle to become fully profitable, or we would have need a move below that $41 area on the downside for the strangle to be profitable on the downside. And so that's, we're just looking for a very volatile move in the market during that time frame. Overall, we covered these straddles and strangles. I would the way I want to introduce you to and teach you the idea of looking at straddles and strangles is the idea of ratioing them. Well, actually, first let's look at So one way or another, we need to be anticipating a sharp move in either direction when we're looking at just a straight out straddle. We want to profit from that sharp move regardless of the direction. And we want to have a higher break even as a result of having to buy 2 premiums versus 1. Obviously, if you believe the market's going lower and you just bought a put and you were right, you're going to make a far more money than you would ever by opening a straddle. And it's just the straddle is for investors that really have are almost saying, I want to passively run a portfolio where I don't want to focus overly on market timing, but rather just participate in the fact that stocks make very big swings higher and lower. And to you, it doesn't really matter whether it goes higher or lower first, because one's leg of your straddle or strangle is going to make money right away, and then it's just about managing it from there, right? So now what I want to cover is the way I would prefer to teach you guys how to do straddles and strangles. Yes, question?
Just before you move on, one strategy I find to be very lucrative is to do a 1-month short strangle. Typically will produce 50% annualized returns. You haven't mentioned that at all.
Well, a short strangle, so you're selling the options on either side, right? And you're doing it naked? Yeah, that's fine. We're focusing on directional strategies in this part over here. A short strangle is a very good income approach strategy, and that would fall under a lot of our income presentations, but there's nothing wrong with that. If you were literally taking the other side of this trade and saying, so long as in the end the stock stays in that range, both those options expire and I get to keep the income, that's perfectly fine. And one thing you'll want to learn to do is if you these were buys. We bought the options, right? They were long strangles and straddles. So what he was asking about is when we're short the straddle, which is that you sold naked the call and you sold naked the put on the other side, and you collected the income rather than paying the money for it. And therefore, you're actually forecasting that the stock will stay within that range. And that is a fabulous strategy when you believe that the market will not be very volatile. If you believe that that stock will stay in a $2 up, $2 down, it's going to stay within a range, then that's a great approach. But one thing I'll tell you is that I would only encourage anyone to do those strategies when they have the discipline as an investor to actually know how to manage it when one of the sides of the positions start challenging you. Whenever you go into anything, naked calls or naked puts, as much as I'm a very big fan of it and I do it quite extensively, there's risk to investors investors that don't have the discipline of knowing how to manage their risk and when to cut a loss and how to trade their way out of a bad situation. If you're one of those people that when you start losing on a stock, you shut off your monitor and come back a week later and hope that it's better, then something like a short strangle would not be a good strategy for you, right? Yeah, that's not bad. Yeah. Yes. Oh, on a long strangle and straddle, there's no margin. But on a short one, you do have to take into account how much they require. But if you're out of the money on both legs, the amount of money that you have to outlay is usually a marginal amount anyway. So it's not a big consideration. It would be if they start getting, one leg gets in the money and starts going against you, where the margin requirements would start spiking up much higher, and then you'd be more challenged on it at that moment. Any other questions? All right. So now I want to take a look, therefore, at the idea of ratioing that straddle. So we're talking about the same straddle that we were talking earlier, but again, if anyone is familiar with us and the way we do things, we market time, and therefore we actually forecast where we believe a stock is actually going. And therefore, if we believe that a stock has a better chance of going up or down, why would we open up the straddle in equal proportion? If we think that it's a much greater chance that the stock's going to go down, why wouldn't we buy more puts than we would own calls in the straddle? Right? Ultimately, what we're doing is you can create a bias saying that I think that this is going to happen, but just in case it doesn't, I'll have one other position to offset it. And so the idea is that it's the same underlying stock, and we have a deliberate bias either higher or lower in the security. So we believe that it's going to, one is going to happen over another. So in this situation, we buy a call for every 2 puts if we're bearish, or we would turn around and buy 2 calls for every 1 put if we're bullish. So right now, if you believed that there's a much better chance that the stock, let's just say at this moment, you wanted to stick your neck out and say, this is where Research in Motion hits its bottom. And you say, I believe that that stock's going to rebound $6. I'm not of that opinion, but let's just say you were. If you were of that opinion, then why would you buy the same amount of puts as you would calls in this situation if you think that Research in Motion will actually go up? You would buy 2 calls, but just in case you're wrong, you buy 1 put. Right, your ratio, and you could ratio it in any proportion that you're comfortable with, but the point is that you're saying that there's a chance I might be wrong. Like with the way that let's say Research in Motion's momentum on the downside's going, if it takes out support levels in the 40s, it could go down to 36. Right, it could. I can't say it can't. So that means that if you turn around and trying to take a bullish conviction here, well, what if you're wrong? Well, that's why that 1 put is there. To offset the chance that if you're wrong on your calls, the put is at least making money against the calls. I much prefer this type of a strategy. Now, because we're doing a straddle, we're doing the same strike and the same expiration, but it doesn't. You can also do this with strangles. I didn't actually put into the books and the slides an example of this with strangles, but understand we're doing the exact same thing. You could ratio strangle the same way you do a ratio straddle. So they're literally the same thing. It's just we're not choosing the same strike price. You're choosing different strike prices for them that way. So the ratio straddle, in this example here, XYZ is trading at $40 a share. Investor expects that the stock will be considerably volatile and will probably, let's say, crash. So in this situation, the investor is actually looking for the stock to decline significantly over this time frame. So the investor wants to capitalize on a big drop in the stock, but wants to build in a hedge just in case they're actually wrong, right? And under these circumstances, the investor would, let's say, take a 3-month $40 call option, which is asking $1.50. And then we look at the put options, which are also asking about $1.50 for that 3-month one. But the difference here, though, is that we buy one $40 call, but we buy 2 of the $40 puts. So now, instead of a $3 outlay, the net cost is $4.50. But understand, where are we going to make the most amount of money if the stock actually declines? Because we are ratioed with twice as many puts as we are calls. And this is a good way for investors to learn to speculate, because it's always good that if you're wrong, that you are making some money on something that reduces the cost of being wrong. And so in many cases, a lot of investors will go out there and say, I believe Magna's going higher from here. And they'll turn around and they'll just buy call options on Magna at the $50 strike. And if Magna suddenly goes back down to 46, and they're sitting there watching these $50 strike call options decaying and decaying, and they're hoping the stock comes back. But if they turned around and bought one put at the $50 strike on Magna at the same time, when Magna dropped down to 46, they turned around and made money on the put, which offsets some of the losses that they made on the calls. They get out of it, and then and the loss was actually smaller than what it would have been if they just owned the calls outright. The $40 ratio straddle cost $450, representing the maximum risk. And when we put that on a risk graph, it looks like this. What ended up happening is that we're going to make money at a much faster rate as the stock is declining, because we own twice as many puts. But under the circumstance that that stock actually rallied, well, if it got above 50, we actually started making money, even though we were favoring the downside. How many of you made money from being wrong? It's ultimately what happens is that when you do a straddle like this and you actually buy a hedge in there to where you say, I believe a stock is going to go down, but you buy a call option just as an insurance policy on your positions. If it moves significantly the other direction of where you're actually forecasting it, it's actually reducing your cost. And therefore, notice here that the maximum loss is exactly at the $40. It ends with a V shape down there. And no matter how much it goes down or up, you immediately are taking less and less of a loss on your position as it's moving away from the $40 strike, either against you or for you. And so what I would say is if many of you in the room here, if you're not option writers, you're rather people that are trying to trade directional moves and believe that you know, timing a stock going higher or lower. I don't know how many of you in the room use technical analysis. Just a show of hands, how many market time with technical analysis? Almost half. So ultimately, how many of you have seen a scenario where you got like an indicator or a candle or something that indicated that you have an opportunity, and you jump in, and then the next day that entire signal just got completely mitigated, and it's now completely moving the opposite direction? Well, if you opened a ratio straddle in the direction that you believed it technically was going to move, if the technical signal was a false one, you have that hedge built in, which is offsetting the position the other way, and you might actually end up making money for being wrong. And it's a very interesting way of looking at it. And I used a 2-to-1 ratio, but you could use a 3-to-1 ratio. Buy one, let's say, call for every 3 puts. It doesn't have to be. Understand that the more you ratio it, then the harder it is to break even on the long side, on the side where you have less of them. But it's always nice to have a little hedge to kind of, if you're wrong, it offsets it. Just very quickly, we'll look at the breakdown here on that ratio straddle. And notice that as soon as that stock starts moving, notice here that you're making money on the net profit all the way on the right-hand side there. Notice that you're making far more money as you're being right on the downside. While on the upside, you're making some money, but it's not going to be even remotely at the same pace as it is when you're right on the downside. And I favor this, and I think as a whole, investors always have a bias. You know, most of you, if I gave you a stock, you would tell me you think it's going higher or you think it's going lower. Everyone has a natural bias as to where they believe something is going. And therefore, to do an outright straddle where you say, 50-50, whichever way it goes, it doesn't matter. Like, it's much more natural to want to ratio it, where you favor one direction because that's where your bias is. And therefore, the ratio straddle is something that I find is a lot more popular with those that learn how to do it over that of just a traditional outright straddle. All right, so welcome back, everyone. And we basically left off with the idea of ratio straddling and the idea of having a bias as to which direction the market is going, and then simply buying another option to kind of hedge out the risk of doing that. I mean, one of the other ways to look at doing that strategy is being long the actual stock with a combination of protection associated with the long stock. Like when you buy a stock and you buy a put as an insurance policy, you don't have to buy the same number of puts that you own stock. You just want to own a certain amount of puts to mitigate the worst case scenario of how much you could lose if you're really wrong on a stock. And so, when you ratio something and you buy different amounts, really our job as traders is really to manage risk. You know, stock markets go up, stock markets go down, and you know, even if you throw a dart at a board or flip a coin, you're going to be right sometimes, right? And the thing is, but what happens is that it's when you're wrong. How much did you lose when you were wrong, and how much damage did you let that wrong trade do to you? And our first and foremost job as traders is to manage risk. Trust me, if you think about it, how trading careers of the individual traders that stop trading or give up on trading, in many cases, they didn't stop trading because they weren't making enough money. They usually stop trading because they blow themselves up. Right? It's you have to recognize that our job, and I always say that, like at Learn to Trade Global Option Source, where I'm from, our first objective is always to say, learn how to manage loss. Learn how to mitigate the amount that you lose, because if you lose small, you can always make it back. It's when you let a position turn into a very large loss that it becomes unmanageable and you're trapped. And we'll talk about that in greater detail as we go. The other thing, I had a question during the break, and the question was oriented around how is an options price actually determined, and who are these market makers, and how do they determine everything? And I wanted to take just a moment to discuss that with you, and so to kind of take the mystery behind the curtain out of it. Ultimately, market makers, if I was to use an analogy of something that you might be familiar with, is a lot like almost like a sports bookie. Ultimately, they don't care whether you're betting on Green Bay Packers or whether you're taking the Steelers. You know, in the end, their job is to price the probability that one team will beat the other and make sure that they gave themselves a spread in there to make some money off of making the book, right? And in the same way, market makers are really not interested in taking the other side of your trade. If you go and buy a call option on a stock, they're not necessarily anxious to be short that option, but they know if they're posting a bid and an ask, if they can, through the transaction process of facilitating the trading, if they're continuously making money off the spreads, then they're getting paid for facilitating liquidity within the marketplace. An old example from a veteran market maker went on to say that making markets is like trying to pick up nickels in front of a moving bulldozer. In the end, they're really just in the end trying to keep enough distance between themselves and so that they don't get run over and trying to pick up nickels, right? And what market making is not this big thing with some person sitting right there and staring at your limit order coming in on your option, and they're like trying to trade against you. In fact, modern market making is completely computerized. And in fact, on some market maker firms, like, actually I won't mention any specific names, but in many cases, market maker firms are completely electronic, where there's one market maker with 200 computer geeks sitting behind them, running these algorithms, and there's one market maker is making markets on thousands of option chains simultaneously. So if you think there's someone personally standing there saying, I'm looking at this one order coming in, they're not. In the end, it's all written into computer codes, and it actually all just automatically happens. It happens by determining, an options price is really determined by actual probability. They really, it's, I've shown in the past presentations, if you've come in the last time I was out here in Calgary, you would have seen that I put on a standard deviation bell curve. And ultimately, market makers are using what's called the Black-Scholes model, or some form of option pricing model that is derived from the Black-Scholes model, which was the original one that was put out. And really, at any one moment, a market maker is simply determining what is the actual statistical probability that that stock could go up or could go down. And that option price is literally just simply reflecting the actual statistical probability that that stock will actually make the move that you're thinking. But now a market maker and this option pricing model gives the stock the exact same probabilities of going up as going down. There isn't very often that the volatility skew is actually skewed. It's usually very even. You'll see that if you go right at the money, a call will usually cost the same amount as a put. In the end, the market maker is saying this thing could go up or it could go down. I'm giving it the same probability of actually doing that. Long as I put all the variables in correctly, then I've accurately priced what that option is worth. What creates opportunity for us as investors is that if we actually have a conviction that we believe a stock is actually going up or going down, well, the market maker's not pricing that option based on it going up. He's pricing it that it could go up or it could go down. And this is where the opportunity to make money is for investors. If you actually understand which direction the stock will most likely go, you can actually profit from it. And that's just the nature of it. But ultimately, market making and what an options price is all just a computerized probabilities model. In fact, we have a number of calculators that we're building that basically dissect that and show the actual statistical probability that the market makers or the option pricing models are actually giving for a stock to go up there. So you can literally determine that based on what the option price is, that they're pricing in, let's say, a 30% chance that the stock might go up $2 up to this price. You can actually see it mathematically what is the actual probability of that move actually occurring. So it's a very interesting thing to look at. But understand that when you're going into the options world, the actual price that this option is worth is just one big math equation. It's not about someone just making it up and saying, "Oh, I feel like charging this much" or something like that. It's all done on computer models based on those Black-Scholes pricing. So now, what I wanted to now cover is the idea of doing collars. And I'm sorry, the question? Absolutely. The question in here was, can I explain why the spreads widen on illiquid stocks? If you think about this, a market maker is striving to always be delta neutral the vast majority of the time. And what that basically means is that they're always willing to buy and they're always willing to sell. They're always showing you something out on the market, and you could step in there. But as soon as they have taken the other side of your trade when you get filled, they don't really want that exposure. And they immediately, by looking at what the delta in a position and so on is, they have to determine how much stock they have to go long or short or offset it with similar stocks and do other things like that to determine how to get as close to neutral as possible so they're not making or losing any money. They just want to make the market and pick up nickels. And in the process of doing that, the more illiquid an options chain in a sense of when they take on, let's say you did 50 contracts of something, it might take them in a liquid chain, they might have to hold that on their inventory for even hours, if not days, before they can actually create an offset to neutralize it. And so therefore, they have to widen the spreads to discount the risk that they may be stuck holding that inventory longer than they wanted to. So the more liquid an options chain, the tighter they can go with the spreads because they know they can immediately offset the position almost instantaneously. While if you're going into mid-cap stocks, and even in the US you go to mid-cap stocks, it's the same thing. Ultimately the spreads will completely widen because the market makers don't have the immediate ability to hedge the offset position of what you're actually doing. And the only way they can protect themselves is by widening the spreads. It's just a function of them being making a market. So back to these collars, and what we want to talk about here is putting your trade on a leash. I just a play on the words there. The idea is that a collar is a hedge wrap. And it's the idea of defining your worst case scenario as well as your best case scenario in one trade. And this is a very effective strategy. You can create it as a position that limits the downside and the upside. And it's ideal for existing positions that have already moved in your favor. I don't necessarily want to always advocate people opening up a collar immediately. So you buy a stock and you immediately collar it. But collars are very effective in a situation where you really like a stock and you've made some very good money on it, but now you don't want to give any of that money back, right? You want to find a way of actually hedging that move, and it involves two strategies, and we'll talk about it. The first component involves a covered call. And therefore, with a covered call, we generate an income, right? And when we generate that income, rather than keeping it as an income, we turn around and we use that money to actually buy a protective put. So in other words, instead of us forking money out of our pockets to actually buy the puts for insurance to protect the downside of the stock, we're using the call premium as a mechanism for actually offsetting the cost associated with that. This is a very valuable strategy to learn, and I'll tell you because I've through the process of training thousands and thousands of traders to be successful at this through our programs. One thing I've learned is that the people that don't succeed in this business have one little problem: they never know how to take their profits. It's one of the most common characteristics of traders that never succeed. How many of you held a stock and watched it rally $10, $15 and then watch it go all the way back to break even? Smiles across the room because welcome to the world of being a beginning trader. But I'll tell you, you'll never find consistent success in the stock market if you don't learn to take the money when you were up. You know what? There's a lot of people that advocate the idea of buy and hold and so on, but ultimately you have to decide whether you're the owner of companies, which is basically like a Warren Buffett strategy where you're going to own the stock for the next 20 years irrespective, and you're going to accept the returns that come with that, dividends and over that time frame. Or two, you're going to determine that I'm in this business to make money. And at some point, if I want to actually make the money, I have to sell the stock in order to keep it, right? There's a question in the back? Okay, the question in the back was, what rule of thumb do I use for taking the profit? You know, we can talk about that actually with this collar strategy. So I think I'll answer your question through the example process here. But what I think you want to sort of, like I'll give you an example of when a collar would be effective, right? Let's just say you bought, let's say, Suncor back in November or December, and you bought it, let's say, for $35, $36, $37 when it was down there. Now you turn around, and over the next 3 months, you watched your Suncor shares rally up to $47, right? and you got this beautiful smile cheek to cheek, right? This is fabulous. This is fantastic. One thing I know about from my experience with those of you out here in Alberta, you guys, when you play energy stocks, you play with play big. There's no like I'm buying 100 shares. Everyone I talk to that plays these energy stock, I've got 5,000 shares of this stuff. You know, you guys like to play it big with these energy names. And so, like, in other words, you would sit there and you would watch this beautiful profit, and you sit there and watch the stock rally up, and you got this smile on your face. But you know, if you love the stock, how easy is it to sell it up at 45, 46, 47? It's not easy at all. You know, it's the equivalent of getting a divorce. You know, you have to get lawyers involved and sign off things like selling your favorite stock. It's like an extremely difficult process, right? And then now suddenly, when you watch Suncor go from 47 down to $38, and you're sitting there and you're watching and you're like, why didn't I take my money? You know, why didn't I at some point take this beautiful profit I had and sell it? And what you'll find is that as investors, we are our own worst enemies. In fact, the psychology of trading is the greatest obstacle for investors in general. It has nothing to do with some moving averages or some technical indicator or what earnings announcement is coming out. In fact, you as an investor and the decisions you have to make, you have to take responsibility for making a decision. And the truth is, as much as everyone finds it very fun and exciting to actually trade stocks, a lot of times investors don't want to take the responsibility of having to make that decision. Right? Because what happens if you take responsibility for, let's say you back then when you saw Suncor move up to $44 and you sold it, and then watch it go to 47, what are you going to be doing? You grab your laptop and throw it through the window. Why did I sell the stock? You're getting all frustrated because you sold it early, right? And then when it goes from 47 back down to 44, you're like, oh, why didn't I sell it up there, right? Ultimately, the psychology behind the decision making is the greatest obstacle. And I'll tell you, all of those traders that we've trained, that we've seen that are very successful, learn the discipline of taking their money when they're actually up on something, because when you take your money, you get to keep it. Right? It's just the reality of the way trading works. And question?
Quick comment, why people don't sell. Two reasons. One is people are greedy, they think it's going to go up more. And secondly, they have to pay tax.
Yeah, the tax issue, and this is why collar is going to be interesting. I'll talk about the tax issue in a second, but absolutely the other reason that people don't sell is because of greed. I would almost, I always like to use the same kind of a storyline, and I think some of you appreciate, even if some of you may have heard it before, but it kind of give you the storyline of what an average investor, and I would say probably 90% or more of investors go through the same, what I call the roller coaster ride of owning stocks. And it sort of starts off where you pick a stock, and let's say let's just use Research in Motion for an example. So you turn around, and let's say right now Research in Motion's at $42. So actually, I don't know what what was its close just right now. Does anyone know where it closed? Anyway, let's just pretend it's $42. So I turn around and I buy some shares of Research in Motion. And I just say, hey, listen, I think it's going to bounce, it's going to go up, and everything's great, right? And so you turn around and you buy it. Now, you say, if it goes to like $46, I'll consider taking my profits. That's not a bad target. You know, make somewhere around 10%, and I'll be happy. I'll get out of the stock and go on. So you buy the shares, and suddenly the stock goes up within a day or two. It's at $43, and suddenly you got this beautiful little smile on your face. You're patting yourself on the back. Good choice, good choice. You know, I'm up $1. Everything's working right. This is fantastic, right? Stock goes up to $44. Now you got a bigger smile and you're thinking this is fantastic, right? And it's slowly working up to $45 and you're like, oh my God, this is great. The stock's going up. And this little birdie starts whispering in your ear saying, take your money. And then suddenly the greed in you saying, but what if the stock goes higher? Let's just give it a little more space, see what happens, right? So then it goes to $46 and you go, I told you I shouldn't have sold it at 45. And see, I'm glad I held. I'm making some good money. This is great, right? Now, you go back and remember that when it was down at 42, you said, if it goes to 46, I'll sell it, right? But now you turn on BNN, and you're listening and thing, and some hotshot analyst comes on there and says, we're setting a price target for the next 18 months of Research in Motion to be at $54. And you're like, eyes light up, cha-ching, and you're thinking, I'm going to redo my kitchen, I'm going to go on this vacation, I'm going to do all of this great stuff, and you're thinking, this is fantastic, right? And so then the stock goes from 46 to 47. You're like, see, I'm glad I didn't sell it, right? Suddenly, a little news announcement comes out. Stock opens the next day at $45. From 47 down to 45. Bam, just like this. And you're like, oh, why didn't I sell it at 47? I would have made a nice profit, turned around, everything would have been fine. And so, but now, you have a chance to sell it right now at 45. How much money would you have made? $3. It still wouldn't have been bad. But do you sell it? Nope. You don't sell it because you say, if it goes to 47, I'll sell it then. Right? So then, it goes from 45 down to 44, and you're like, oh, why did I just sell it at 45? I could have bought it back at 44. But now, if you don't get $45 or $47, it's not good enough, so you're going to hold it. Then you watch it go all the way back to $42, right back to break even. You had this beautiful chance to sell it for $4 or $5 profit, but you don't. And you didn't, and sell it anywhere along the way. Now you're break even. So now you start justifying, well, I've been in the stock for a month. I can't sell it at break even. Let's just see if it pops here. It's a little oversold. Let's see what happens, right? Stock drops down to 40. And you're like sitting there and you're staring at your screen. I can't believe I let this stock turn into a loser, right? And you're sitting there staring at this thing and you're thinking, well, you know, I can't sell it at a loss. You know, it's still a good company. And you start, that's when you start doing what's called fundamental research. So then you pull out the balance sheet analysis, what the CEO's doing. I got to justify why I'm going to own this for the rest of my life. And so you start doing all your research. Then it goes from 40, it starts rallying back, 41, 42. Now, all the technicians out there are saying, oh, look, the MACD just rolled up, and oh, look, the moving averages are rolling back up. And everyone's like, the stock's finally going, maybe that was a bottom. So do you sell at break even? No, right? The stock then turns around from 42, drops down to 35, and now you're called a long-term investor because you ain't selling that for the next couple of years. This here is what 90% of investors do. They take themselves on this roller coaster ride. And really, ultimately, the problem there was that never once was that investor prepared to take the responsibility of actually making the decision to actually sell the investment. In the end, they thought they would, but they weren't. Because if they sold it, they would regret it. And if it kept going up, and if they didn't sell, then they would regret it. And then turn around, and you're fighting all these emotional things in your head, and you never allow yourself to make any effective decisions. Now we're going to look at caller example, but let me give you an example. If you, let's say, bought TD Bank shares, or let's say Suncor, or anything like that. Let's say we bought Suncor, and you wrote it up to $45, $46, $47. Well, what if, at this point, if the stock already rallied like $10 or more on the upside over a short time frame, even though the stock may continue to go higher, what is the real probability that it will move another $10? it's probably not as high probability as the first $10, right? Because the stock becomes overvalued, the valuations thing, some value managers will start distributing it. At that point, if you've already made $10, there probably is not. You can't say there isn't a chance it can go up another $10, but it's not really a realistic expectation. And so at this point, you have a marginal amount of upside potential, but what do you have a lot of risk of now? Profit taking. It doesn't mean Suncor is a bad stock, but welcome to the stock market. This is what they do. They go up, and then they profit take, and then they go up, and then they profit take. Welcome to the world of trading, right? But if we turned around and sold a covered call up when, so let's say Suncor was at $45, what if you sold a $48 covered call? And you said, I'm going to continue to make money on the upside of Suncor up towards 48, and I don't want to cut off the upside, but I use the money that I just made off that call, and I buy a put insurance policy that guarantees that I can sell my Suncor shares at a profit. What have you now done? You've removed that emotional variable, because now you can continue to make money on the upside of the stock, and you can roll that covered call, and you could do all sorts of different things. But if that stock reversed, you just guaranteed to know where your exit is, at a profit. And if that stock turned around and dropped all the way below your break even and into a losing position, you're not losing, because that you have that put, which you have the right to exercise and get out of the stock at a profit. This, to our members, we were huge advocates of doing these strategies over the last 2 months, over the last month. You know, if you rode up these bank stocks, if you rode TD Bank from $70 up to $86, it's, you know, you're sitting on $16 profit in a couple months on a bank stock. Let's be realistic. That's not what bank stocks normally do. Bank stocks are dividend payers that stay sideways. If you made $16, now if you sell it, you're going to have to pay capital gains and do all this stuff. But if you collared it, we were talking about doing all sorts of collars. You turn around, you buy a protective put to lock in where you can sell it. You sell some covered calls. You get to keep collecting dividends. You keep collecting, and you don't have to realize your capital gain, because you just have to sell the put at a later point. You don't actually have to lose the stock. And what you've done is you've created a scenario where you actually had the choice of how to lock in your profit. I'll tell you, this one simple strategy alone will change your entire investment approach, because the one thing that, like I said at the beginning, the one biggest problem, the traders that I've seen that cannot succeed at this are people that have a very big problem taking money when they're up on it. You have to, trust me, in this game, you have to learn to take your profits in order to keep them. Now, again, that's assuming that you guys are traders. I mean, for the active trader and the active investor, ultimately, if you're using a Warren Buffett approach of long-term holding that investment, you can still use options to offset risk. I mean, it's been known that even Warren Buffett has used protective puts as a mechanism for offsetting at risk or locking in. In the end, he doesn't sell his shares. If the stock corrects, he actually just sells the put and profits from the put, and which acted as a hedge for having owned the shares. But we're learning how I mean, I think the biggest stereotype overall is, and if you talk to any of your friends, neighbors, family, anyone that is not an existing options trader, and then ask them about options, the first thing they'll say, options are risky, aren't they? Because options have been stereotyped to speculators. But I'll tell you, if you educate yourself on how to use options correctly, it is actually one of the most conservative approaches for ensuring that you lock in profits, learn to make consistent cash flows and incomes off of your stocks, and most importantly, how to stay in control of your trading process. And that is the single hardest thing to do, is staying in control. And all of you, I'm sure, are capable of doing that. You just have to learn how to do that, right? And I hope all of you take the time to learn more about these strategies that way. So when do we use the collar strategy? We use it if you are optimistic on an investment, but you have short-term concerns about the stock. And the concerns can be technical. the concerns can be fundamental. What makes the strategy effective is it's volatility neutral. Just like the debit spreads that we said earlier, if you're doing it on a very volatile stock at a very volatile time, if you're buying a very expensive put insurance policy, you're also collecting a very big covered call premium. So what happens is that you offset it. If the volatility contracts or expands, the one is completely offsetting the other, and you actually were neutral on it. While if you just bought, during a market decline, if you just bought a protective put, you might be paying hurricane-style insurance for buying that protective put. But if you offset it with a collar, you were able to actually offset a huge amount of the cost associated with buying that insurance on the downside of your stocks. So let's look at an example. Here we have an example of XYZ. It's trading at $40 a share. And the investor likes the stock, but has short-term concerns. And one of the most difficult things that investors are always challenged with is the idea that they'll have to pay capital gains on their investment. If I sell it, I have to pay the taxes on it. And what was very effective about this collar is you're actually building in a hedge without the disposition of the underlying stock. And even then, let's just say for 1 second, if you bought into the adage of sell in May and go away, and right now you felt that the next 4 or 5 months as a whole represented a period where money was not made in the stock market, and being as a whole in a very large cash position is a prudent thing in this environment. But if you turned around and liquidated your entire portfolio into cash, if you're especially holding a basket of high dividend paying stocks, you are forfeiting 2 quarters worth of dividends in an environment where there's no guarantee the market will crash. It might just be sideways. The stock market might not do nothing, and you're not collecting those dividends. But if you opened up a collar and you bought a protective put, and you turn around and sold a covered call, you're at least continuing over the next 3 to 6 months collecting those dividends, holding it. But what you've just said is that if the stock market does decline in any rapid fashion, I've hedged it out. I'm not going to take any devastating damage to my investment portfolio. A very valuable way of looking at that. Now, investor wants to buy a stock and collar it. In this situation, we have a 1 month $42 call on this bidding 25 cents, and a 1 month $38 put also is asking 25 cents. So what happens here in this example, when we're looking at it, we turn around, we buy 100 shares at $40, and when we sell the covered call, so we're just doing a normal covered call trade like you would do on your account in any way, and you made 25-cent income for actually having sold the covered call and owning the shares. So how much upside do we have on the stock? $2, right? If we're right and the stock does rally, we can have the potential to still make a reasonable return within that time horizon. But we turn around and we buy a $38 put in this example, and that $38 put guarantees us to be able to sell the stock at $38. So if that stock turned around, dropped to 36 or 34 or 30, well, you know what? You're guaranteed to sell it at 38. It just didn't matter. Right? And so what we've done, but how much did it cost you? 0 cost on the collar. Because in the end, you used the income you made off of the call to pay for the put. So one of the biggest problems with just using a protective put strategy is that it outlays huge amounts of cash to buy all these puts. And a lot of people psychologically have problems doing that. I was advising one individual who had a very large position in Research in Motion years and years ago back he originally bought all the shares at $120. And the stock Research in Motion at the time rallied to $140, and he was sitting on $20 worth of profit. And I said, well, why don't you turn around and buy a $140 put and lock in your sale price at $140, continue to have all of the upside of Research in Motion, but there's no way you can lose money. By the way, that's my favorite type of trade. I call that the risk-free trade, where you're using your profits to buy the put, and you're guaranteed to get out at a profit. You know, that's, to me, the first rule is don't lose any money. You have to learn those types of strategies, right? And ultimately, under those circumstances, at the time, that put for Research in Motion was trading for $13. And he's like doing the math. You want me to spend like $13,000 to buy these protective puts? Are you crazy? He's saying to me, right? But you know, if that was too much, he ended up just not choosing to insure it at all. Obviously, you can see that that was a bad decision. But ultimately, if that put cost $13 and was too expensive, well, what if at the time he turned around and sold a $50 covered call and collected $4 or $5 for it? Well, at that moment, you reduce the cost from $13 down to like $8. What you're doing is you've reduced the total cost of insuring that position while not cutting off the upside of Research in Motion to continue rallying. The point is that under all circumstances, owning stocks is great, and you can continue to make money on stocks and find different ways of doing it. But you got to find, the problem is if you don't have the discipline to sell a stock at a loss, you need to learn to hedge. Because I'll tell you, a lot of people are scared of the word naked call and naked put. But I'll tell you, when you own stocks, you're naked stocks. You have all of the downside and all of the upside. Sorry? No, don't have time decay, but you're still naked the position, which is, because in the end, in my eyes, when you see the word naked, it basically means you have an undefined loss potential. Yeah, when it goes against you, you don't know how bad it can get. But when owning a stock, it's the same. You know, when Techcominco went back in 2008 from $50 down to $3, and then all the way back to $50. Like, you know, investors are asking the question, well, how bad can it get? Well, it can get pretty bad. You know, it's like what you have to realize is that if you build in a hedge and you have a protective put, if you know that you don't have the psychological discipline to sell a position at a loss, you might as well build in a put insurance policy on the stock position, even if it's at a lower strike, to ensure that if things get really bad, you at least weren't losing a lot of money in the process of that going against you that far. It's very important to learn how to use options that way. So ultimately here, the cost of the collar was $0. And the downside risk was down to $38, and your upside potential was up to $42. You know, ultimately, you can see that you have the same risk versus the same upside potential. It's a 1-for-1 ratio. But if you have any market timing bone in your body, you can, if you have more winners than losers, then you'll find that you're making money on collaring stocks like this. You know, even if you have a 60% success rate in finding them, you know, on the ones that you lose on, the winners will always be, you'll have more of them, and therefore you'll always be making money in the bigger picture, right? But ultimately, you just have to remove the risk of catastrophic loss. And I'll tell you, I don't know whether you can relate it to yourself or whether you can relate it to someone you know, but I'll tell you, the most devastating thing is taking a major hit on a portfolio. Because if you, let's say, have a $100,000 portfolio, and that portfolio goes from $100,000 down to $60,000 in a very rapid market decline, the problem is making $60,000 back up to $100,000 is not easy. It's not easy to make back that loss. The first secret is never letting your account get down to $60,000. It's, you know, if you lose $2,000 on this trade, well, and your account's from $100,000 down to $98,000, well, guess what? You'll be there to fight another day and make the money back. But letting your account go from $100,000 down to $60,000, now you've got a very difficult challenge ahead of you trying to make that money back. And I'll tell you, like I was saying, the first rule of learning to be a successful trader is learning how to risk manage, learn how to calculate the worst case scenarios and remove catastrophic loss risk. You know, a lot of people will use the XIU options as a hedge for their Canadian portfolios. But what they'll do is they'll buy those XIU put insurance 10% below where the market is, because they look at it and they say, hey, I know that the stock market fluctuates up or down, but I really need the insurance policy against a market crash. You know, if you turned around and lost 10% on your portfolio, you can make it back. Trust me, that's not hard. But if you watch your portfolio drop 20 or 30%, now you're in a far bigger trouble. So you don't always have to build your hedges at the money. You can build your hedges out of the money, farther down, but you got to always try to remove catastrophic loss. Because if you guys can remove catastrophic loss from your portfolios, trust me, you'll have a good trading career. It's like, you know, I'll tell you, if those people that walked away only down 20% in 2008, they're making a very large amount of money right now. You know, if even during a major market decline, it's hard not to lose some money when every stock is just rapidly declining, right? And you're going to take some form of a loss, you know, unless you were an ultra bear and you were just shorting the oblivion out of the market, you know, but if you were an investor and you were net long stocks, if you walked away from 2008 down 15, 20% on your portfolio, right now you are very nicely up. But if you turned around and lost 40 or 50% during that time, you're just hoping to get back to break even at some point here. You know, and this is why this collar strategy, I want to keep pumping this into your heads. This is such a valuable thing to learn, because it doesn't cost you anything out of your pocket. In the end, or at least if it does cost you something, it's a small amount, because the covered call is offsetting the cost of the put insurance, right? And therefore, what you're doing is it doesn't really cost you any money to really to insure the downside risk of your investments. And like, I'll give you an example. Those people that were opening these collars, I don't know how many of you, let's say, own any of these banks, right? I don't know, but like whether you right now are sitting at in TD Bank at 82, or any of, you know, BMO or BNS or any of these other ones sitting, you know, in the 60s. Right now, you saw these beautiful rallies in these stocks, and now you're pretty nervous because they seem to be going down every day. And they're down a little bit, down a little bit, and this little birdie in your head is saying, well, you know, these are still great stocks, so, I mean, how much worse can it get? What happens is that you take all of the downside risk, and if these banks, for whatever reason, in a big market correction, come back down to where they were trading before this rally, you're going to find that you had this opportunity where you were up 15, 20% on the bank stocks. Now you're back to break even. Well, congratulations, you made a dividend. You know, like ultimately, if you sat there and if you made all of those profits on those stocks, if you turned around and put a collar on it, what if you turn around when TD Bank was, let's say, up at $84? What if you did an 82 collar? You sold an 86 covered call, bought an $82 protective put. Now, are you going to be really losing any sleep? Well, you know, I mean, if TD turns around and drops to $77 in just a corrective pattern, well, you know what? My $82 put is just worth $5 right now, and I didn't really lose any of the money while I'm sitting there collecting the dividends and doing everything else along the way. You want to learn to implement this strategy with your stocks. It's that simple. You know, the only thing that I want to emphasize is that in order to do this strategy with the covered call component, is you must accept the fact that there's a chance you might have to sell your stock. That's a part of covered call writing. If that stock rallied up to those levels and on expiration, someone may choose to want to buy that stock from you, and you have to be prepared to sell it and therefore realize a capital gain. So if you're in a situation where you have a very, very big capital gain on the stock and you don't want the disposition of the stock on there, you have to use a creative strategy for hedging the downside without ever losing the stock as a covered call writer, whether you continuously roll up and out or do other types of strategies. There's all sorts of more advanced ways of doing that, but ultimately, you know, you need to somehow put something into your trade that allows you to make some money and keep it, right? So in this example, notice that the caller created this risk graph right here that looked almost exactly like the debit spread, did it not? Ultimately, you have a limited upside and a limited downside. The caller actually shares a very similar characteristic to a debit spread. The difference is that when you own the actual stock, when you actually own the stock, it didn't cost you a premium to own it. And so the break even on a debit spread is moved to the right. While on a caller, in many cases, you can keep your break even right at the price where the stock is trading. But I mean, that all depends on whether you go in the money or at the money or how you change the dynamic. But the point is that what we've done is we collared it. We created a limited upside and a limited downside. And we really can't suffer catastrophic loss while we're actually trying to make money off these stocks. Very good strategy for dividend. If your primary objective is collecting dividends, this is a fabulous strategy for you, because the dividend income is being paid to you all along. And what you're doing is simply trying to always remove catastrophic loss on a stock while you're sitting there collecting dividends. And so usually dividend-paying stocks tend not to have very dramatic rallies. They tend to be far more range-bound channeling stocks in general. I mean, there's obviously certain trends within the stock market where stocks will move very rapidly in one direction, like those bank stocks did move in the last little bit. But in the bigger picture, most dividend-paying stocks are quite boring, right? And as a whole, if you're sitting there trying to collect the dividends, then building collars around your positions is not bad. Now, earlier, there was the idea of doing the covered call and then selling a put on the downside. But essentially what you've done in selling the put is you've just, you're going to collect twice as much income, but at the same time you have double the downside risk. It's the exact opposite of the collar. In the end, if that stock had a big drop on the downside, you now have to own twice as much of it. So you better love that stock a lot. Because if it goes against you, you're going to own more of it, right? Again, there's a million. What you'll see is that once you learn why an options price does what it does, it allows you to build strategies based on what you believe that stock will do and what your objectives are as an investor. And this is why I really don't like when investors pigeonhole themselves to one strategy. Because somebody told them, let's say, that a calendar spread is the best trade in the world. Right? And suddenly those guys will just sit there and will just trade calendar spreads all along. And it's like, well, why do you just limit yourself to that? Well, what is it that you're trying to achieve? And, and then you talk to them and you realize that they just want to get consistent returns from the stock market. I'm thinking, well, that's not the strategy I would be using if I was looking for just consistent returns. In the end, all of you, in order for you guys to all be advanced traders, and sophisticated professional traders and do this for a living, you first have to learn why options do what they do, and then determine what is my objective as an investor of what I want to do, and then determine what option strategies allow me to meet the objectives that I'm trying to achieve. And I'll tell you, through the thousands of traders that I've trained through our programs, I have yet to ever meet two traders that trade the same. What's the one certainty in the stock market is that every investor and trader is completely unique. You all have a different perception of what you want out of the stock market, how much capital you have access to, how you're going to achieve those returns. And therefore, I can't cookie cutter and say, this is the right strategy for you and this is the wrong one. For half of you in the room, this might be a great strategy. For the other half, there might be a better one that's suitable to you. The most important thing is to learn why you would use this strategy. And if you understand that, you'll know how to build these types of option strategies for yourself. And that's what our objective is to educate all of you to a level where you will have the confidence and the know-how to build these types of strategies. Question?
Sorry to interrupt, but I'd like to reinforce that. One of the big learnings I had was when I started thinking what in fact is a market. It is impossible for everybody to trade the same way. There would be no market.
Absolutely. Absolutely. And just I'll repeat his comment, but basically what makes a market is everyone has a different opinion. And that's like one person wants to buy the stock at this price and another person wants to sell it at this price. There's always somebody there. And and if everyone tried, think about it, what would happen if everybody tried to buy the stock at the same time and nobody wanted to sell it? The stock would shoot up to such an astronomical level that the move would actually be over before anyone gets filled. Right? What makes a market is that there's buyers and sellers continuously, one person thinking it's a good opportunity to get out while another person thinks. And this is why overanalyzing or listening to those guys on TV is really a waste of time, because ultimately they're giving you an opinion, but their opinion is just their own. Ultimately, in many cases, they'll turn around and sell, there's no way I'll buy the stock, and that stock then turns around being a perfect buying opportunity. And if everyone traded the same way, the market wouldn't be a market. The most important thing is that we can't always be right. The first rule is when you're not right, how are you going to make your loss a small, manageable one that you can actually trade your way through? Because there's no one that is always going to be right. I've yet to meet that holy grail trader. It doesn't exist. In the end, you're just trying to make continuously good decisions and try to come out on the winning side enough times that you're happy with the type of money you're making through the markets, right? So in this example, you can see that no matter how high the stock goes, or no matter how low the stock goes, your gain or loss on this $40 stock cannot be more than a $2 gain or a $2 loss. And ultimately, when you can open collars at different strikes. In this situation, I opened $2 higher and $2 lower on this collar. But there's people that I know that will open the protective put right at the money, so buy a $40 put, and they'll turn around and sell a $42 call or a $44 call. Now, the put will be far more expensive than the call, so it's not a wash on the premium. It actually outlays money, but they outlaid a lot less money than they would have if they just bought the put outright. And so there's other traders that I'll know that will sell covered calls pretty much right at the money, and then they'll use a portion of that premium to buy catastrophic loss risk premium by going $4 or $6 lower on the strike. They'll buy a put protection for a quarter or 10 cents. Their objective is to sit there and make covered call income, but if that stock had a catastrophic loss or something really bad happened, they had an insurance policy in there that made sure that the loss on that stock was going to be something that they were prepared to take and never got out of complete control, right? And so there's a million different ways to collar, and it's not a right or wrong answer, but it's all about what the net objective is from the way that you collar it. The second way that I wanted to teach it was the idea of a calendar collar, and I like this one as well. It's an interesting way of starting, and I particularly like this approach when you're a technical analyst, because when you're a technical analyst, you usually have a very specific reason why, from a technical reason, why you wanted to buy right now. And for those of you that are technical analysts in this room, how long does it usually take to find out if you're right or wrong? Relatively quickly. It's not like you have to wait 3 months to see if your technical signal worked or not. If you were right or wrong, you'll know within a week or two. So in most cases, you actually don't need to buy very long-term protection. But in the same regard, if you're right and the stock's rallying, you want to make sure you gave it enough room to actually be right about your technical forecast about being right. And so a calendar collar is an interesting approach to looking at that. Now, we're again trying to create a position that limits the downside risk, and obviously it's going to limit the upside in that trade. It's ideal for positions about to bullishly break out. So I'll use an example from a call perspective, but it's an interesting approach. What will happen involves obviously the two strategies. But what it does, the first one is we're going to, first is obviously a longer term out of the money covered call. So whenever you see in an option strategy when they use that word calendar, It doesn't matter which option strategy it is. When you see the word calendar, it means they're using a combination of options that are at different months, right? So some might have a May month, and another leg of it might have a June month or a July month. What happens is when you see the word collar, or calendar, it means that they're doing different month strikes. So if you looked at all the straddles we were doing and other things like that, we were all working within the same months. And so therefore, they weren't calendar straddles. But what would a calendar straddle be? A calendar straddle, like we'll go back to the beginning thing, is let's say I believe the stock was going higher, so I buy, let's say, 3 or 4 month call options. But if I'm wrong, I'm going to be wrong right now, so you buy 1 month puts in the straddle. So you have 3 months or 4 months worth of calls, but you have the protection of the straddle on the put only 1 month out. So if you're wrong on it and it goes against you, well, it's only a short-term insurance policy that gets you out. While if you're right, you have lots of time for those calls to make you lots of money. So that would be called a calendar straddle. So once you learn the different option strategies, the foundations like what I showed you, once you understand why an option does what it does and the way it behaves, you can combine all sorts of different ways. And this is what makes the market so unique, is that certain people will suddenly have this eureka moment and they say, I love this way of trading. And they create their own way of wanting to look at the market. And I'll tell you, that's one of the things I've found with a lot of successful traders is when they find a way that they love to trade the market. And when they find the way that they love, they're very passionate about that way. Like, I'll sit there and, at the end of this presentation for the next 3-4 hours, I'm going to be sitting out there and I'll always have people come in there and they'll just come in there and spend 15 minutes explaining to me their strategy. And I love hearing that, and you feel free to do that if you want afterwards. But the reason is that when you find your option strategy, your way that you like to look at the markets, you become very passionate about it. That's the way you like to look at it and trade it. And that's perfectly fine. That's what makes a market, is everyone's got to find their way of how they want to do this. You don't want to try to use all like 26 different option strategies, and it'll be too confusing. You find your own little niche, your own little way that you want to do this. So in this calendar collar, once we sell that longer term covered call, the second component is buying a short term at the money put. So think about that. By buying a short-term at-the-money put, especially if this was a technical reason why you were buying it, we're going to find out if we're right or wrong very quickly in owning the stock. If we bought it because it was bullishly rolling up, it's either going to go or it's going to reverse, and we don't want to be in it. And it's not going to take 3 months to find out whether we want to be in it or not. We'll know probably within a week or two whether this trade was a dud. Right? And so we only buy a short-term protection, but we use the proceeds of that longer-term covered call to buy that protection. So let's look at it as an example. So when would we, first of all, use this strategy? Is when you're optimistic about the investment, but you have short-term concerns. It also allows as a way of also making it volatility neutral. So remember, we were talking again, volatility neutral. The biggest problem investors have is that the time when they want to go to the options market tends to be when there's a huge emotional charge in the stock market. The market's either crashing or something's happening, and they immediately say, I want to buy the stock, look how cheap it is during this crash, or two, I need to buy a put to ensure the downside because I'm losing too much money. Usually the time when an investor makes an emotional triggered decision, it's usually during like a rapid decline or something like that, and they tend to buy that option when it is the most expensive. When it costs too much to do it. And again, what a collar, just like the debit spreads, is volatility neutral, because the option that you sold is offsetting the cost of the option that you bought. And even though they're both very expensive, the two have offset each other, and therefore making it a much more neutral trade that way. When I say short-term concerns versus you're optimistic, trust me that the time when you have the greatest risk in an investment is the moment you buy it. The greatest risk is right away, because psychologically the biggest problem investors have is that they more often than not, they are not willing to sell a stock at a loss. And so if you buy a stock and it immediately goes even 1 cent against you, you're now a long-term investor. because you're not going to sell it at a loss, right? I mean, understand that the greatest risk in buying a stock is the moment you actually buy it. And so what I always say is that when you buy a stock that you want to own in the bigger picture, initially buying a very short-term protection, even though you have no intention of buying protection for the life that you'll own the stock, is a fabulous strategy. Because if, let's say, you think right now, let's say Suncor's trading at $40 off of 47 coming back down. If you suddenly say, look, I'm buying Suncor 20% discount from where it was at its highs, and you say, right now, I want to buy. Well, if you buy a short-term protection at the $40 strike, let's say on Suncor, if Suncor if let's say oil continues to decline from 95 down to, let's say, 85, and all these energy stocks continue to sell off, if Suncor goes from 40 down to 36, well, you're going to be smiling all the way down. Why? Because you're going to sell your stock at 40 and buy it all back at 36. You get a second shot at your first entry, right? If you thought it was a great buy at 40, well, you're going to really love it at 36. You know, what happens is that if you, but what happens if you didn't buy the put? Well, now you got the stock's got to rally $4 just for you to be back at break even. And you're in that psychological rut where you're stuck in a stock and it's down. And you're like, why is it down? When is it going to come back? And you don't know how to manage it through, right? What's beautiful is when you buy your favorite stock, if you create a strategy that ensures the downside risk while you initially take the first position, there's nothing better than getting a second shot at getting a better price, right? And in the end, in a collar, if we collected income off of that position to offset the cost of the insurance, how much would it really cost you to do that? Little to nothing. So in the end, you have a shot at getting in your favorite stock at a much better price, and it really didn't cost you anything to do that. Like, it baffles me when people don't want to learn about options. Like, you know, like, I love the stock market, but I'll tell you, when you learn the power of using options as a tool to actually use in combination with your stocks, it's absolutely amazing to see how you can manage risk and reposition yourself and take advantage of different things. And so many people are like, oh, I don't really want to learn about these options. It's risky. It just blows my mind. You know, and I commend all of you for taking the time to actually make it out here to learn this. You know, you guys coming in here and spending an entire day to educate yourselves, I commend you on that. You know, that's I think that all of you are going to start seeing success in your trading because you take the time to educate yourself on how to do this. And I wish all of you the best for that. Now, let's do an example of a calendar collar. So here we have a stock trading at $40. Investor likes the long-term stock potential, wants to own the stock. There's no issues or qualms about that, but obviously has short-term concerns on it. And so the investor wants to buy the stock and collar it. In this situation, let's say a 3-month $42 call is bidding $1. In the same regard, a 1-month $40 at the money put is also trading at $1. But now notice that when the other collar, we bought the $38 put. But here what we did was we bought a $40 put. So we are guaranteed to sell the stock at break even. So do you ever have to be at risk of watching that stock go into a major losing position? No. In the end, you are guaranteed for the next month, no matter what, you can sell that stock at break even. So if that $40 stock drops down to 36, what are you going to do? Sell it at 40, buy it all back at 36. Thank you very much, right? There's a question. We'll talk about that. I'll repeat your question. We'll talk about that in a second. But what I want to emphasize here, so in this situation, we buy 100 shares. we buy the $40 put and we sell the $40 call. So right now what we've done is we've created a net cost of $40 because the $1 we made on income offset the $1 on the put. Now the thing is that it's a zero cost for the caller, but understand if we have to close the position early, we do have to give some money back to buying back a call. If we wanted to close it out early. So if, let's say, that stock was to go up and you wanted to just get out of it, well, you actually have to pay a certain amount of premium to buy back a covered call if you wanted to do it early. So understand, but recognize this, if the stock went down, though, if the stock went up, it's the same as being a covered call writer. So you would literally use your covered call writing strategies the exact same way that you would use on the stock. But if the stock was to drop, if let's say it goes down to $36 over 1 month, so 1 month later, forget 3 months later, 1 month later the stock's down at $36. How much do you think that call will be worth up at the $42 strike with only 2 months left on it? It'll be like a dime. So in the end, when you're wrong over the course of that month and that stock moves against you, that 3-month call completely almost covered the entire cost of the put. Even though there was 3 months of time on it, that you would have actually realized almost the entire gain on the covered call in that first month because that stock moves so much against you during that time frame. And so it creates a very interesting scenario. In the scenario that the stock's going higher, you've cut yourself off from a covered call writing perspective, and you may not realize the full gain that you wanted to. But if the stock went against you, you have no risk. And it's a beautiful scenario. Anytime you can explain to me a strategy where I've almost removed all the risk of owning the stock while I have upside potential, you'll see a smile on my face. That's my favorite trades. Right? Tell me a scenario where I don't have to lose any money and I have the potential to make money. That's the way I like to trade. I don't know about you guys, but come to me and show me a strategy where we can mitigate risk and yet have room to make money on the stock. You're talking my language, and especially when you're talking high net worth individuals, right? A lot of individuals that have $10,000 in a trading account, they have to take a little bit of risk because they're trying to make real return that is a much higher percentage, right? If you're trying to turn $10,000 into $20,000, you have to take a little bit of risk to try to make a real bang for your buck. But if you're managing $1 or $2 million, the first goal is not to lose it. If you already got, $500,000 or $1 million or $2 million, you're trying to live off of this money, right? So the way someone with $10,000 would treat their account versus someone that's treating it with $1 million is far different. And I'll tell you, when you're dealing with $1 million, $2, $3 million, the first goal is don't lose the $1 million. Because if you don't lose it, you can actually live off of it. But if you turn that $1 million into $600,000, now you've got a problem. Right? And so what I would say is these collar strategies favor considerably high net worth individuals. If you're someone that's got a very large account and you're trying to make a living off of that account, if you end up over the course of a year using these collar strategies only making 10-20% return on $1 million, I think most of you can live off of $100,000 or $200,000 a year. I mean, it's not unreasonable. You don't have to shoot for the fences for these 50 or 100% return strategies. You're just trying to make a living off of that, and our goal is not to lose it, right? And you want to develop a strategy. Any questions? I saw some hands. Yes. The question in here was, would you close the covered call if the stock did drop to 36? And the way I would answer that is all dependent on what it is now that you want. Do you want to buy back the stock at 36? Or do you want to just rid your hands of the entire investment? In some situations, if you can hold a naked call, you can close out the stock position and the put and just let the naked call expire, because the odds of now, when it's at 36, of over the next 2 months of hitting 42 is a very improbable event, even though it could happen. But at that point, you have a pretty big cushion of it being wrong. But if you can't hold naked calls, then you would just turn around and close the call. and you buy it back for a dime or whatever. But the way I would see it is that a lot of times in those situations, what investors will choose to do is they'll turn around, they'll sell the stock at 40, exercise it. They'll just call the brokerage, say, I want to sell the stock. The clearing corporation next day settles it out, so you see it leave your account at $40. You go in there, put a market order, buy your stock back at 36, and now the thing is that call is now a covered call on your $36 stock, so you don't have to close it. At that moment, you can just hold the stock at $36 with a 42 covered call against it and see if the stock will rally back for you, right? Okay, the question in there, I'll repeat it for everyone, is that the objective is obviously for it to be volatility neutral, like I was emphasizing. But if you turned around and bought the stock back at 36 and you bought a brand new put down at the $36 strike, you no longer are volatility neutral because that first call was offsetting the second. At this point, what I would, in many cases, some traders choose to do is that when they close the original position at 40, they'll buy back that other call up out there for, let's say, a dime or 15 cents or something, and then they'll turn around and open a trade like if it was brand new. And so they'll create a brand new volatility neutral strategy down at the $36 strike. And so at that moment, you might buy a $36 put and sell a 38 or a 40 covered call against it, going out 2-3 months. And you just repeat the process just the same way like you originally opened it, but you're just doing it now at the $36 level. It's not a right or wrong answer, but ultimately the point is that if the stock did drop, let's say it went 36 down, like let's say you did this strategy, this would have been a fabulous strategy on Research in Motion over the last 3 weeks, right? But you know that at some point it was going to go into its earnings announcement. It had a very nice rally off of its worst point, so it was moving up. At some point, buying an at-the-money put as an insurance over its earnings period and turning around and selling a covered call a few strikes higher for 2-3 months out. Right now, when Research in Motion did that big gap down from 52.50 up there down towards 40, it went down to 46, 44, and then it continued to decline lower. Guess what? What price would you be selling all your Research in Motion stock at? Up in the 50 range, and you could buy back that call for a nickel or a dime, and then you turn around and you could be buying back your Research in Motion shares right here in the low 40s, right? Ultimately, what you did was you never had any of that risk. But subsequently had all of the, you continued to participate on the upside of the stock, but you hedged it all out. There's nothing better than your favorite stock crashing when you have a protective put, because you have a smile from cheek to cheek because you know you're going to get to buy your favorite stock back at a much cheaper price because you're going to sell it up there and buy it all back down there. Trust me, there's nothing like cheering your favorite stock down lower while you own it. You know, you can't do that as an investor, and as an investor, it's an extremely painful process watching your favorite stock dropping. But when you have a protective put on your favorite stock like this in there, you're cheering it on. You're like, go a little lower. I want to buy you down here, right? It's a completely, you'll see the psychology of your trading completely changes when you use options in combination with stocks, because you completely change the entire dynamic of what your expectations are while you're trading. So in this situation, in this example here, because I have only 10 more minutes, I need to finish these slides. The downside risk is 0 for the stock, and you buy back, other than the buyback risk of the call. So we might have to pay a dime or a nickel or 15 cents or 25 cents to buy back the call if we have to close it when it goes down. But beyond that, it really was no risk, right? And you have the upside potential toward 42. And when we say upside potential 42, it's not limited to that, because what we can do is we can do rolls. And I'm going to teach you about rolling right here. And we'll spend the last 10 minutes, because a lot of people, when they open up a debit spread or they open up one of these collars or even a strangle, they feel that they're married to the exact position that they're in. But in fact, after a stock has started moving, there's all sorts of decisions that you can make while the stock is already moved, rather than just being static and saying, this is my position, this is the way I've committed, and I'm just going to do nothing for the next 2-3 months and just see where it ends up. You can be proactive and make a series of decisions while the stock is making the moves, right? And so we'll let's look at what we can do now in this situation, managing spread positions, and in the same regards, a collar. Like for instance, if the stock did rally from 40 to 42 on that calendar collar example, well, we could have rolled the 42 covered call up to the 44 strike and continued to let the stock continue to rally because it's moving in your favor. You could make all sorts of decisions along the way rather than just accepting the static return. Now, here in the situation, if there's only two things that happen to options. Either they're out of the money and the option expires, or two, it's in the money and needs to be either closed, rolled, or exercised. So that's going to happen. What does in the money again mean? If I'm assuming that you guys all being here on the advanced side, that everyone understands that. But if just to repeat, just in case some of you don't, is when there's an intrinsic value inside of that option. And that's an intrinsic value doesn't decay. If you have the right to buy a stock at 36 and it's trading at $40, you have $4 of intrinsic value because you have the right to buy it at 36 and it's trading at 40. That part of an option does not decay. That's not a time decaying component. It will always, that $4 will always be in that option because that's what you actually have a guarantee of doing when you exercise it. And so that's when we see the word in the money, we're just saying that there's a real value to that option, right? Now, in this situation, let's say we have a stock. It's at $50, and we buy a 50 to 52 bull call spread. So we're doing a bull call debit spread, the strategy we covered the very first one of the day. All right, and so we buy the $50 call for $1.50, and we turn around and sell the $52 call for 50 cents. And it cost us $1 out of our pocket, right? And so now, let's just say in the first week of having this, notice we did this for 3 months, right? So 3 months out, but in the first week, the stock goes from 50 to 52.50. And you're like, bam, now suddenly the stock is above your spread, and if the stock keeps rallying, you're not going to continue to participate. You made your 100%, you're not going to be upset, but you're not going to make any more money, right? So, so you really have... let's say everything technically looks good and you can continue to participate on the upside of the stock. Really at this point you have three things you can really choose to do. You can do a vertical roll, you can exit the position early, or you can hold till expiration, right? And I just want to kind of review with all of you what are the merits of choosing one over another. On each one of these choices. Now the first thing that we're going to do is let's look at rolling the short call. Which is that $52 strike. So a week later, now that 3-month $52 call, which we collected 50 cents for, is now bidding $1.50 to $1.60. All right? Why? Because it's in the money already. With the stock trading above $52, there's already 50 cents intrinsic value on the short call. And now we can look and see a 3-month $54 call is bidding 65 cents, asking 75 cents. So, so what we can actually do is we can roll it from the 52 up to the 54 and continue to participate on the upside of the stock if we felt that there was more upside potential. So in this scenario, if we buy a 3-month $52 for $1.60 and we sell a 3-month $54 call, now we still always own the 50. Remember, we originally bought that $50 call. We're only rolling one leg of the spread. We're only focusing on the short call, which is that one at the 52. You can go back to the debit spread part in your books if you wanted to refresh yourself on debit spreads. But in the end, we're only focusing on that one call that's at that $52 strike. And so we buy it back. Remember, we sold it. So how do we close the position? If we sold to open that one leg of the spread, we have to buy to close it back. Right? So we buy to close that position for $1.60, and now we sell a $54 call for 3 months for 65 cents. So if we paid $1.60 and received 65 cents back, we paid an additional 95 cents on this debit to open it up towards participating in the rally up towards $54 now. So now instead of you being boxed in between the 50 and 52 strike, now you've opened it up so you can participate from the 50 to 54 strike. And now you have a total of $4 potential in the spread versus $2 potential like you did originally. Now, overall, I don't really like doing this kind of a roll. For the caller, it would make a lot more sense. If, let's say, in that calendar caller, that stock started rallying from 40 to 42, well, now you could roll it from the 42 to the 44 and keep participating on the upside of the stock. Because we really were bullish on it originally. But for a debit spread, you really opened a $2 spread and you were looking for a 100% return on it, right? Because if you paid $1 for a $2 spread, if you made the money, you made 100%. I mean, are you going to complain about making 100% on a position? It's like, I think really in the end you just have this emotional need to keep participating in the stock. But really, if your objective was to say the stock's going higher and I'm going to try and make 100% return on the spread, then I don't think you need to roll it. But if you wanted to, you can. It's just a matter of taking that strike price and rolling it up to another one. The other alternative is you can just close it early. How long were you committed to this original trade? For 3 months, right? We're 1 week into it. 1 week into a 3-month spread. And right now, if you look at what the bid and ask on that 50 and 52 is, you can see that we can close the spread for $1.50. We paid $1 for it. If we close it for $1.50, we made a 50-cent profit in 1 week. So you can either A, wait for another almost 3 months, 2 months and several weeks to try and make an extra 50%. Or you can say, I just made 50% in a week. Thank you very much. I'm just going to close it, and I'll look somewhere else to a new trade, right? So there's nothing wrong with just closing the position early. In many cases at Option Source, when we're doing these strategies, we'll open a debit spread for 2 months out. But when the position moved in our favor in the first week, we say, well, look, you know what? We've already achieved the spread in a week. Why are we going to hold this for another 3, 4, 5 weeks? Let's just close it out and take our profit and lock it in, right? And so there's nothing wrong with closing it early. And the last thing, of course, is you can just do nothing. You can say the stock's rallying. If I do nothing 3 months later, so long as the stock's above $52, then I make 100% return, and you just leave it, right? It's not a right or wrong answer. I don't ever want to give anyone an impression that you should do this one and not do this one. That's very irresponsible, in my opinion. The most important thing is for you to have an outlook of what you believe something will happen, and then ask yourself, what is the best decision for me to do? Because my goal is to make money. And sometimes taking your money early, a smaller portion of it and taking it early is the best choice, right? But other times holding the position for the full length of the spread is the best choice. You have to assess it completely on the market outlook. Right now, for example, anyone that's been opening bull call spreads on the market over that let's say still have 2 months worth of time, well, you sort of timed it wrong, because traditionally the stock market goes through a difficult period in May and June. And so right now, if you're sitting on beautiful profits on bull call spreads, this is a time to consider closing them early and taking the profit that you're already up, rather than taking the risk that the market may go through a correction over the next 2 months and give back all the money that you're already up. While in the same regard, if this was back in November of last year, and you're sitting on a nice profit on your bull call spreads, there was nothing wrong with just sitting there and holding them and realizing their full potential over the subsequent month or two, right? And so it's never a right or wrong answer. You have to look at it in the circumstances of what stage we are within the market trading cycle.